You've watched the YouTube videos, you've followed the risk management, and you still can't pass the prop firm challenge. Let me show you why and
expansion, that type of thing. In this case here, you can see the price moved almost 400 points in the afternoon session, and it went up into a rejection. Okay, another example here, S&P E-mini. We have our PM trend time window delineated here. And again, we can see another rejection block form. Price trades down into the previous range, trades below the last down close candle's closing price, and at the beginning of the PM session, that large red candle violates that previous session or AM session's rejection block, and there's an accumulation phase that takes place, and the market rallies about 18 handles. Nice PM session day there. Now we're going to look at the PM session or PM trend on the Dow E-mini futures. Again, it's the same delineation in time. We're looking at how price moves in the form of a rejection of previous high or a turtle suit. So the afternoon session can create a reversal, or it can be a continuation. In this case, we see the afternoon session creating a reversal. Okay, now we're going to look at the NASDAQ E-mini futures. Again, the same delineation in time. Looking at the market trading down into a order block that was formed during the lunch hour, and the bullish order block sends price higher up into a rejection block that was seen forming in the morning session. In this case here, we see about 9 full handles traded up into, going into the close. Nice PM session trade. And you can see it trading into that rejection block as noted here. Alright, as we've shown with the index SMT for the AM session, the same thing applies for the PM session, but we're going to be looking for the highs and the lows between noon and 3 p.m. New York time. So the relative highs and lows that form after noon or 12 p.m. New York time to 3 p.m. New York time, we're going to be looking at the relationship between all three of the indices and their respective lows or highs. And if we see, and for instance, when an institutional order flow is bullish, we're going to be looking at the lows comparably. One indice is going to fail to confirm a lower low that's usually seen, or what we typically seen in all three. When that occurs, that's bullish. We're seeing this occurring in the PM session here, and the opposite will be seen with institutional order flow when it's bearish, where we compare relative highs, and one indice is going to fail to confirm higher highs when all three of them would be moving higher. One will fail to move at a higher high, and that will be deemed bearish. In this instance here, we can see that the E-mini S&P in the PM session on this particular day, during the afternoon session, we saw a higher low form, and the Dow futures has shown a higher low as well. But notice what we see here in the NASDAQ futures contract. We see that it makes a lower low. That's a break in what would be expected. Normally, we would expect to see the NASDAQ create a higher low as well. For a symmetrical market, that's perfect. That would be viewed as confirmation. But what we're seeing here is there's an accumulation in the Dow and in the S&P, not seen in the NASDAQ. So while the NASDAQ was the lethargic sister, or sixth sister of the three, the Dow and the E-mini S&P both showed relative strength by failing to make a lower low, and you can see the reactions after the divergence was noted. 2 p.m. here is the equivalent of 3 p.m. in New York time, because the bar chart uses the Central Time or Chicago time. And by looking at that divergence, we can see that there's a strong accumulation in the E-mini S&P and in the Dow. Now again, I use these divergences to signal trades in the E-mini S&P, or when I used to trade the S&P, it would be just me using these reference points. And if I see that crack among all three, my trade's going to be taken in the S&P. I'm not trying to trade the Dow or trading the NASDAQ futures. I'm primarily focusing on this crack to tell me if there's going to be an upside movement in the S&P or a downside movement in the S&P. The drop down on this particular day in the morning session, that could have been dropping down into a higher time frame discount array, and then it showed a rejection early on in the morning, and then we saw the larger, higher time frame move unfold going into the afternoon session. And the accumulation that's seen by way of smart money, their footprint is seen here with the divergence with the index S&T. So now we've contrasted the characteristics of the AM session, we've introduced the quiet period of the day, the lunch hour, and then the restart or the resuming of activity with the PM session trend. Again, it begins around 1 p.m. New York time and extends all the way to 4 p.m. at the close. The last hour, 3 p.m. going into the last hour of equities trading, that last hour can create the opposite end of the range. Now, we mentioned in the AM session teaching that typically that opening range or first hour trading creates the higher low of the day. Now, if that's the case, then we know that the last hour of the trading day, which is 3 o'clock to 4 o'clock New York time, generally will create the opposite end of the range. So if we see a low form in the morning session and it's been a really strong up day, and during lunch we see no retracement and the PM session starts to indicate they want to go higher too, we can feel confident that any trade that we trade in the same direction that was made from the AM session will continue going into that last hour of trading. So as soon as the bond market closes at 3 p.m. New York time, that's usually when the market makes its high or low in respective terms to what was seen in the AM session. So the AM session creates the low of the day or suspected low of the day. The last hour, 3 p.m. to 4 p.m. New York time, will create the high of the day. If the AM session or first hour of the trading day creates the high of the day, then we know that most likely if it's going to be a down close day, it will continue to go lower until the bond market closes. And shortly after it's 3 o'clock, you'll see the low of the day form as it goes into the close at 4 p.m. So hopefully this has been insightful to you. We're going to blend these things into a cohesive trading plan. Our next lesson is going to talk about how we can pick targets once we understand what session we're going to be trading in. Until then, I wish you good luck and good trading.
Where should you invest $100 today? Well, according to Elon Musk,
Welcome back, folks. Again, this is a discussion about commodities. So take a moment to read this disclaimer. As a reminder, I'm not a CTA, I'm not a licensed commodity trade advisor. Everything that's mentioned here should be viewed in the light of a paper trade only. Okay, folks. June 2017, ICT Mentorship, Index Trading Concepts, Lesson 4, Projected Range and Objectives. Okay, before I get into it, just want to remind you that index trading can be, like anything else, overcomplicated or it can be simplified. And the conversations that we're going to have here, I want you to understand that this is how I interpreted for the last 20 plus years the internal movements of how indices operate and how they operate on a day-by-day basis intraday. There's going to be some deviations from these ideas that obviously will not help us in any way, shape, or form, but these are my general classifications or how I interpret how the daily range should fulfill for indices and index trading. The first is 2-session up close, and view is typically with the daily and 4-hour institutional order flow should be bullish. The morning trend, or the AM session, typically we'll see a return to a discount array, and then price will rally. The lunch hour consolidates with shallow retracements, and the PM trend runs the lunch hour lows, sell stops, or drops into a fair value discount array, then rallies into the close. Now a little bit about this specific projected range. The daily range could actually go straight through the lunch hour with very little consolidation whatsoever. Depending on what was the catalyst that sent prices higher, it could be a very strong economic or surprise economic news that was released early on. And while we're looking for basically a measured move type event, first leg up in the morning consolidation and the second leg of equal distance seen from the AM session, seen in the afternoon session, don't be lulled into thinking that if it's a strong bull day, that it will consolidate always the entire lunch hour. Many times it can just continuously trade higher through the lunch hour. I'm just giving you a general, kind of like a generic view of how I interpret the price action, how I forecast it, how I think it may unfold. Obviously nothing's guaranteed, nothing's set in stone, but by far and large, these 8 ways of projecting the range that I'm going to show you in this teaching will pretty much fit the bill on most days. Okay, 2-session down close. This is the opposite of what we just shown. Institutional order flow will be bearish on the daily and or 4-hour chart. The AM trend will return to a premium array, then declines. The lunch hour consolidates with the shallow retracements. And the PM trend runs the lunch hour highs for buy stops.
Place trades with simple order management tools. Access over 40 built-in indicators plus
or rises into a fair value premium array, then declines into the close. Much like we just said as it relates to strong up days, the lunch hour may not see the entire lunch hour consolidate. It can actually trade through the lunch hour going lower. Depending upon, again, whatever the stimulus was that set the day off. Could be a very strong economic news was expected to come out and it disappointed. The number was a disappointment, and it could have been a strong disappointment, so therefore the market's going to discount current levels and just rapidly reprice lower. The impact of seeing these types of days, obviously it's like a trending day, you want to be focusing on when the daily and 4-hour are bearish, and opposite seen with up 2-session up close days. You want to see when the daily and 4-hour is institutionally bullish. If we are in the middle of a intermediate term or long-term price swing based on what we would see on a higher time frame chart, this is the classic scenario. Now when we start approaching higher time frame 4-hour and daily opposing arrays, in this instance here we would be looking for 2-session down close, or basically a big down day. That down close is high probability until we get to a 4-hour or a daily or weekly discount array. So when it starts trading into those levels, obviously the same thing is said in opposite terms for the 2-session up close. If we're trading in the middle of a swing or intermediate term price swing has yet to complete, and we have not traded up into a 4-hour daily premium array, that scenario should unfold for a 2-session up close day. For a 2-session down close day, this is the criteria we're looking for as long as the 4-hour and or daily discount arrays have not been traded to. So it makes it very easy for price to expand lower. Okay, now we have AM rally, PM reversal. Institutional order flow is bullish, and this is seen on daily and 4-hour, but it's underneath, for instance, a 4-hour higher time frame premium PD array. So in other words, price has been going up. It's yet to fulfill a completion of a bullish run, but very close to where we are presently, there is a higher time frame premium PD array, and it could be seen on a 4-hour or it could be a daily. But the AM session will start off bullish until it hits the higher time frame premium PD array, which causes the intraday market reversal. The AM trend returns to a discount array, then rallies. The lunch hour consolidates with shallow retracements. The PM trend runs the lunch hour highs, then reverses into the close, or it runs the intraday high, then reverses into the close. So it could create a higher high in the PM session that was seen on the intraday, or it could just simply run above the lunchtime hour and then reverse there. So in other words, it could create a lower high that was formed in the New York AM session. So don't think that it has to create, like as this diagram showing here, a higher high in the PM session relative to the AM session. It could just be a higher high relative to what was seen during the lunch hour, which would create a failure swing on the run into the AM session's high. And the PM trend can resume higher if the AM session discount array that it rallied off of equals a higher time frame discount array. So we could see it recapitalize that same level once it trades down to it in the PM session. They can recapitalize that discount array and send it higher. If there is no higher time frame discount array that's saw price rally away in AM, say for instance maybe it was a 60-minute, okay, or a 15-minute discount array that caused the AM session rally, then obviously we could look for price to continue lower. But if that New York AM session discount array happened to be a 4-hour or a daily or a weekly discount array, or say like an instance of order block that's bullish from a higher time frame, if it trades back down to it in the PM session, it could reverse there and trade higher and resume going higher. The filter is if it's not a 4-hour or a daily.
I have to tell, you're built like a pro. My husband says chest is the hardest muscle to build. What's your superset?
I don't have one, no gym.
No gym, how?
I'm 44, I don't waste time there. I do military count.
Or higher than that discount array, expect it to trade through it go lower. Okay, the AM decline, PM reversal. Institutional order flow is going to be bearish, but it's yet to trade down into a discount PD array on a higher time frame. So prices above a higher time frame discount array from a 4-hour or a daily basis, or even higher. AM trend returns to a premium array, then declines. The lunch hour consolidates with shallow retracements. The PM trend runs the lunch hour lows, then reverses into the close, or it runs the intraday lows, then reverses into the close. So again, like we just said, with the AM rally, PM reversal, this day we can see the lunch hour lows can be violated or traded down, run out the sell stops for any short-term lows created during lunch hour, and then rallies in the PM session. Or the PM session, as shown here, it runs out the low formed in the New York AM session, then reverses and trades higher. The PM trend can resume lower if AM session premium array equals a higher time frame premium array. So everything we just mentioned for a AM rally PM reversal in relationship to what the higher time frame array may be, if the AM session premium array that it trades up to and sells off from, if that equals a higher time frame 4-hour, daily, weekly, or monthly premium array, it can be returning back to it in the PM session to recapitalize that same level and then go lower and resume lower. If that's not the case, and we don't see that higher time frame 4-hour, daily, or higher premium array that the New York AM session keyed off of before it dropped down, then we can expect price to continue through and make an attempt to run higher. Consolidation, AM rally, PM decline. Institutional order flow is going to be neutral or it's going to be unclear to you. So if you're ever questioning what the institutional order flow is for a particular market day, and it's not obvious in terms of where we're at relative to premium or discount on daily or 4 hour, chances are we could probably see a scenario like this, especially if there's no real high impact or medium impact news expected during the 10 o'clock hour or later in the day in the afternoon. So if there's a vacuum of any real market drivers, you can expect a particular projected range to unfold. AM trend is going to be seen by returning to a discount array, then price rallies, or after the first hour or the opening range, or expands higher from equilibrium to run London buy stops, or it could be intraday highs for the buy stops. At the time of this recording, this is the actual projected range I used for the June 22nd, 2017 trading day for the SPOOS market, where I sold short at 24.37 and look for the price to trade down into a discount array or reach for sell stops below the marketplace. So this is the actual projected range I used for a live trade example. So you can see how I formulated the idea and used it in a real-time example today for your learning. The lunch hour consolidates with shallow retracements. PM trend runs the lunch hour highs, then reaches for the day's sell stops, intraday sell stops, or it runs the intraday high, then reaches for intraday or London sell stops. Now, obviously, what's the criteria? How do we know which one it's going to do? In other words, is it going to just run the lunch hour highs, or is it going to run the intraday high? That depends on which is a premium array. In other words, if it's a higher time frame premium array that AM session hit, then it's likely that it won't go back up there because they've already defended that level, and it may just want to run the lunchtime hour highs. Now, if the AM session has not traded up into a higher time frame premium array, like an hourly or 4 hour chart premium array, then the afternoon could run the intraday high and then reverse.
Which is hot.
The PM trend can simply consolidate into the close after the lunch hour as well. So it can make all the movement in the morning and then just fizzle out and go sideways the rest of the day through lunch and into the close. Consolidation AM decline, PM rally. This is just the opposite of what we just saw. Institutional order flow again will be neutral or uncertain to you. The AM trend will see price return to a premium array, then decline, or after the first hour of trading or the opening range, price will expand lower from equilibrium to run London sell stops. The lunch hour is going to see consolidation with shallow retracements. The PM trend will see price run the lunchtime lows, then reach for the day's buy stops, or runs the intraday low, then reaches for intraday or London buy stops. Now again, as I mentioned in the previous slide, what scenario would you expect? Which one would you look for the PM trend? If the AM session low trades down to a higher time frame discount array, then the New York PM session will only look to run out the London lunch low. If the AM session low, in this case, does not trade down into a higher time frame discount array, then the New York PM session will look to run out the intraday low and then rally. PM trend can simply consolidate into the close after the lunch hour as well, just like we said in the previous slide for consolidation, AM rally, PM decline. Now, when we're looking at this particular day right here, when the market's not predisposed to trade higher with a trend or lower with a trend, this is the classic scenario where you see that tug of war back and forth. This is what you'll see a lot of times in index trading, which makes it very frustrating if you don't understand the mechanics behind it. When there's a strong directional bias behind the marketplace, or the underlying pinnings of the market suggest higher prices or lower prices. Do not look for this particular scenario. Okay, this is not seek and destroy. It's simply consolidation. Now, in non-farm payroll, there is seek and destroy conditions in S&P, but generally, this type of day will fulfill if there is a lack of trend and lack of news. So, as you can see, there's only 8 projected ranges that I use for the S&P, and it makes it very simple to anticipate what it is that I should be seeing on respective sessions, the AM session and the PM session. Now, obviously, the lunchtime hour is the same. It's the same thing across all of them. Consolidation with shallow retracements. The only time that the lunch hour is different is when we see the trending days, the 2-session up close or 2-session down close days, because lunch can actually be active during those days, but it's always going to be relative to what was seen as a catalyst that drove price higher or lower for those respective days. So hopefully this is giving you more insight as to how I interpret projected ranges and how we can look for objectives in price action using stops, because that's what we understand the indices look for. They seek stops, and they on a higher time frame can trend, but on an intraday basis you have to understand it's all about liquidity and where the stops are. It's a trader's market, so therefore they're going to hunt stops predominantly. And until the next lesson, I wish you good luck and good trading.
Passing a prop firm challenge is easy. Staying funded, that's where 95% of traders fail. And if you've ever
Okay folks, welcome back. This is our final discussion this month, June 2017 content regarding commodities and futures. But I have to remind you one more time to take a look at the disclaimer here. It's very important. And as a reminder, I'm not a CTA, I'm a licensed commodity trade advisor. Everything that we discuss here should be viewed in the light of a paper trade only. Alright, June 2017, ICT mentorship, ICT index trading concepts, lesson 5, index trading. Okay, so I gave you the range projections and objectives lesson in lesson 4, and I'm going to amplify those for trade setups for indices. And as you're going to see here, it's rather simplistic, which is exactly what you should be looking for setups. If you overcomplicate it, obviously you're going to have a million questions and never come to the end result of understanding. So the first one we're going to look at is 2-session up close. And when we look for the AM trend to return down to a discount array, what we're actually looking for is we're looking for an index SMT divergence on the lows. They're going to be comparing the lows from the London session into the 9:30 AM. The AM session is usually going to reach up into a expansion move. It can be a higher time frame PDA, but generally you want to be holding out for time of day, which is 10:30 to 11 o'clock in the morning, typically as we understand it in Forex as the London close. But we want to be holding on to it with the idea that it's going to expand going into the lunch hour. Now, when we get into the lunch hour, it can go in consolidation, and again we can be looking for a retracement back down below the lows formed in lunch, or we could be returning back to a fair value gap or bullish order block seen inside of the lunch hour. At the lows that's formed in the lunch hour and the low that forms immediately after 1 o'clock New York time, those lows are going to be compared against the 2 other averages. So when we look at the S&P, we're looking at the Dow and the NASDAQ, and we're going to be comparing lows at these specific price points. There's no ambiguity here. It's highly specific. We're going to be looking for the indice to diverge. One of them. It doesn't have to be the E-mini S&P. If the NASDAQ fails to go lower, that in itself supports the idea that the S&P should rally and go higher. And again, as we go into the later portions of the day, going into the close, we're going to be relying on time of day as well as we did with the AM session. Now, when I mean relying on time of day, we have to do what we can to hold for time. Remember, the day is going to expand as we get close to the closing price or closing hour. We want to get the maximum amount of daily range in our favor. So if we're long, or trying to get long in AM or the PM session, it's most beneficial when we're holding for the maximum potential range that could fulfill in a daily candle. So if we're looking at the E-mini S&P and we see bullishness underway and we're long, and it's only 2 o'clock in the afternoon, we've seen some handles in our favor, or in other words, paper profit. Don't be aggressive about trying to take those profits off the table, because you want to allow the time of day to come to a higher level of delivery on price, which obviously will lend well to getting a higher profit. The more you hold towards the close, the more opportunity there is for you to make more of a range. The AM session and the PM session highs initially are going to be most likely a 15-minute or a 60-minute PD array. Now, since we're looking at a 2-session up close, both the AM session and PM session PD array is going to be a premium array. Now, again, it could be a 15-minute premium array or a 60-minute premium array, but you're aiming for that for both sessions. Now, if you notice how I have the diagram on the PM session, going into the close, it could be 2 stages. It could fall short of a 15 or 60-minute PD array and start to retrace. Look for an additional ramp up that last hour going into the close till it reaches the 15 or 60-minute PD array or premium array. Okay, we're looking at the 2-session down close. Again, in the morning, when we see price return to a premium array, at that moment, we're going to be comparing the other 2 indices, the NASDAQ and the Dow, and we're going to be comparing the highs for index SMT, again from London into the 9:30 opening equities, and we're going to be holding till 10:30 to 11 o'clock in the morning, relying on time of day to get to the maximum amount of range. As we get close to 11 o'clock, there's more likelihood of a consolidation or pause going into the lunch hour at noon. And during the lunch, we're going to be looking at the highs comparable with the NASDAQ and the Dow futures against the S&P. And again, this can be a return back to a fair value gap, or a bearish order block, or closing of liquidity void and then go lower, or
imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea.
You can run the lunch high for buy stops and then reject, but you're looking at the highs during the lunch hour, and you're looking at the high that forms post New York lunch. When that happens, and it forms, there's always going to be some measure of a short-term high that forms immediately after lunch. And if you're looking for a 2-session down close profile to unfold, projecting that daily range, we're going to be looking for weakness immediately after the lunch hour closes. So from 1 o'clock in the afternoon, New York time, we're immediately going to be hunting and stalking the E-mini S&P's short-term high. So if the price was rallying up, we're going to be looking for reasons to suspect a fair value play, or return to fair value for selling short at a bearish order block, fair value gap or liquidity void, or a run above or a move above the New York launch. In the PM session, again, we have to rely on time of day. Don't just take a couple handles of profit. Hold on to it. Head towards the close. At least try to hold on to it until 3 p.m. bond close. And if you can do all that you can to hold on to it into 4 o'clock, it's ideal to do that. The AM session and the PM session intraday lows. Again, again, are going to be many times lined up with a 15 to 60 minute PD array. Since we're looking at 2 session downflows projected range, it's going to be a 15 to 60 minute discount array. Now in the PM session, again, that many times can happen as a 2-stage short-term rally where early profit will be taken. If it does not do that short-term bounce at a logical 15 or 60 minute discount array, hold for it to break another leg lower going into the close, and then that later point at which it trades lower.
must continue.
Many times we traded at 15 or 60-minute discount array. All right, we're looking at the AM rally, PM reversal, projected range. In the AM session, we're going to be looking at the three averages, NASDAQ, Dow against the S&P, and we're going to be comparing the index SMT on the lows. So we're going to be looking for a divergence. One of them will fail to go lower. That will signal the time to be a buyer of the E-mini S&P for the New York session. And we're going to be relying on time of day, holding until we get to very close to 11 o'clock or just past 11 o'clock as we get into the lunch hour. And again, ahead of noon, many times we'll see a little bit of a profit-taking retracement. And then in the afternoon, we're going to be looking for a rally to sell into. And we're going to hold that until we get to time of day and price. So we have to refer back to that discount array in the AM session that caused the initial rally. And if it blends well with the higher time frame discount array, obviously we expect a short-term bounce, maybe back into consolidation or resuming higher, take out the daily high. But if the daily AM session discount array is not a higher time frame discount array, we'll look for continuation on the downside and take out the intraday low. In the afternoon, that high is going to be a 15 to 60 minute premium PD array. In the AM session, in this case, it creates a lower high than that which is formed in the PM session. If that short-term high forms before lunch, if it's below a 15-minute or a 60-minute premium array, then we're going to be anticipating, before it even happens, the initial move outside of the London lunch around 1 o'clock in the afternoon New York time. Then it will rally up to the 15 or 60-minute premium array, and then anticipate a higher time frame market reversal to fall as indicated in this diagram. Now, know what you're thinking. 15 is not a higher time frame, and neither is a 60-minute. But we're going to be looking for a overlap or a nested premium array that's seen on the 15 or 60-minute and daily or 4-hour. So the higher time frame confluence with nested ideas of premium array would be our catalyst for this PM session reversal. AM decline, PM reversal. In the morning, we're going to be looking for the index SMT divergence on the highs, going from the London session into the 9:30 a.m. equities opening. One of them bearish. Then one of those three indices will be bearish divergence, indicating a New York AM session decline. We're going to be holding again for very minimum 10:30 a.m. and closer to 11 o'clock. At 11 o'clock, anticipate some measure of consolidation or retracement going into the lunch hour. In the PM session, we anticipate a run on the daily low or the low seen in the lunch hour. Now, again, we hold on to the later portion of the day. At least try to aim for holding till 3 o'clock bond close, New York time, if at all possible. If it gets to the premium array that saw price decline from the AM session, we could see price resume and go lower. Or if that AM session premium array is not a higher time frame premium array, we can anticipate further upside and then the intraday high being taken out. In this diagram, the AM session low, anticipate what it looks like.
My healthiest friends kept saying the Mediterranean diet changed their life. Factor made Mediterranean eating
Analyzing the data, it speaks volumes to me in terms of of everything that you've been introduced to and exposed to. And I want to ask you, why do you believe I made you go through the content that was shown in June? I believe that some of you felt like filler, like it wasn't necessary, it wasn't needed, or I'll come back to that later on in ICT. And it's unfortunate that some have felt that way, because the purpose of having multi-asset class analysis, that is the asset classes of the bonds, currencies, commodities, and stocks, is by looking at them as a whole, how they're interrelated, and all the things I covered this month. I want you to go back through and look for the symmetry between all four, because there's a common theme that I'm trying to draw your attention to, but you can't grasp it and you can't appreciate it until you see it, until you see the interconnections and when they're most likely to be in sync with one another. What am I talking about? Risk on and risk off. Some of the things that you folks are in here hoping to see right away, I want to see this, I need to see this, I have to be a witness of this, or I have to be taking trades. Some of you didn't listen, and I said it wouldn't be a trade signal service. And I want you to think about, what was the point of all these lessons for this month? It wasn't that I was highlighting certain phenomena that I like about each individual asset class. It's the fact that they both not only work in harmony with one another, but sometimes they decouple. If there's a decoupling, in other words, if the bond market is going higher, that means that there's a scenario where it's less risk interest. It's a risk-off environment. So the market goes to buying bonds. When the bond market's going lower, then there's a risk-on scenario. Risk-on scenarios bring with it the buying of stocks, the buying of foreign currencies. These back and forth ebb and flow type phenomenon have a reverberation that goes through all four of the asset classes. And to discount it, to think that it's something I'll come back to later on, I don't think I'm really interested in learning commodities. I don't think I'm interested in looking at the S&P 500. I don't think I'm interested in looking at stocks. All of you know I only trade Forex. And yet I still talk about the bond market, commodities, and stocks. Because it matters. It has a place. And some of you want to be one-trick ponies and I'm only going to be able to make money if I have to follow one thing and I have to close my eyes to everything else around me. Well, to be a specialist, you still have to understand what the general market's going to do, most likely. And the importance of it is that when the markets are working well together, when all of the asset classes are doing as they should, risk-on environments, everything should rally. Interest rates should be declining. If you're not seeing these things happening, if there isn't this beautiful dovetail with all four of the asset classes, then you're going to have a very hard time finding opportunities where moves can be explosive. They can have a lot of magnitude. They don't last very long unless those conditions are there. And we have been going through a period of months where it's been very difficult to ascertain whether or not the market is risk on or risk off. Sometimes it is, sometimes it isn't. Some of the asset classes are doing as they should, while others are doing something completely different. Some of the folks that are no longer with us have grown tiresome. They don't want to deal with this anymore. It's grinded them down. And they left for a reason. Because they're never going to be traders. They're never going to be able to do this. Because it takes a lot of wherewithal. It takes a lot of conviction. It takes hard work. You got to look at all four of these asset classes to get a grasp on what the general market's doing. You want explosive moves. You want big, directional, one-sided markets. That's going to come by way of understanding the four asset classes. If you cannot read what those asset classes are doing, individually and as a whole, collectively, What's the dance between them? Are they moving in symmetry? Are they working beautifully together? Or are we seeing a chaotic mess? The markets are doing whatever they want to do, indiscriminate to whatever the other asset classes are doing. Why would you think that takes place? Why would we see a multi-asset class decoupling like that? Because there's a lot of uncertainty. And when it's easy to make money, and there are times when it's like that, all four asset classes will be working in harmony with one another. They'll be doing as they should across the board. Dollar index goes higher, commodities go lower. Stocks go higher, risk on. Risk off, stocks fall. Currencies, foreign in nature, rally when it's risk on. Decline when it's risk off, and dollar will rally. This mechanism that we look at in terms of the marketplace, it is highly efficient and yet very hard to decipher because it takes a lot of work to be looking at other things, not just I want to be looking at only my euro dollar. I just want to trade euro dollar. I don't care what the bond markets are doing. I don't care about any of that. Can you make money doing it? Yes, you can. Will you understand when the large moves are going to take place and how long to hold on to them based on those conditions? Just looking at the euro? No. Some of you are trying to do that. Some of you are trying to skip to the head of the line, avoid all this hard work because you don't want to roll your sleeves up. And it's necessary. You have to do these things. Because if you don't, when you have periods of drawdown, when you have periods of where the market just isn't giving you what you want, you're going to lose your mind. You're going to allow psychological things to impact your ability to trade, to make decisions, hold on to trades, or let go of them. Because you will have an absence of your understanding about the general market as a whole. I can't tell you the dozens of emails I got throughout this entire month. Can I skip this month?
What's with all the hands?
I'm getting a hand from LegalZoom.
Why? There's so many smart influencers who give.
Can I just not worry about this? Can I just pay for the next month and not be a part of this group? And I was saying the same thing to everyone. It's important because you felt that you were never going to be a commodity trader, so therefore commodity information is useless to you. And you're never going to actually trade the bond market, so everyone was interested in what I had to say about the bonds. And it's interesting, as I got through the bond market content, then folks were like, well, do I have to pay attention to the rest of this? Yes, you do. And if you're having a struggling point where you don't want to do this, you don't want to look at the other asset classes because it's too much work, it's too much, then I'm going to challenge you with this. You're going to struggle. You might have hit and miss success. You're going to have periods where you might make a little bit of money, but you will always feel like there's just something that doesn't quite click. And it's going to be this. You have to know what the market's going to do as a whole. And if there's a decoupling and the markets are having erratic behavior, the assets are not working in harmony with one another, it goes back to if that only is going on presently, or we're coming out of that hopefully at the time of this recording, what has it been saying all along? That smart money is not willing to make large contributions to one side of the market or another. Or they're waiting on something. What are they waiting on? I'm not sure what it is they're waiting on. There's a lot of things on the horizon. Some of it's war, some of it's Brexit, Middle East, Trump being in office, maybe not being in office. There's a lot of things that's going on right now that it's making it difficult, and it's actually disinteresting. And I would admit that if I was coming up as a new trader, I would feel the impulse to say, well, I'm really not going to pay attention to this. But I can tell you, there's a lot of things that I went through in my development that I felt that way about, but I later went back to them, and it caused me the greatest growth spurts in my understanding as a trader. Part of the mentorship was for you to pay for me to give you the things that helped me get to a point when I can understand what the market's going to do. You can see when I'm wrong. It's been glaringly obvious the periods where I'm not doing well, and it's because of the multi-asset class analysis of these 4 asset classes. They're just doing whatever they want to do. But when there are periods where I can see everything, I can see it clearly, what's going on. Example of it was this week. I do a lot to do this mentorship, and sometimes my attention's drawn into areas where I otherwise wouldn't be looking. But because I am a mentor, I do my best to try to give feedback and answers to questions by way of email. And some folks are calling me, and some people are sending me texts, and there's a lot of you. And I do all those things and make lessons and do recordings and edit, and it's a lot.
Yes, sir.
And I can only do so much as a human being. I can't force you to do the things that I believe are necessary. You're going to have an opinion. You're not going to pay attention to this teaching. You're not even going to listen to this video. Get your fingers in your ears. La 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 la. But it's something that's important. I wouldn't have done this month if I didn't wholeheartedly believe that it was beneficial to your understanding. You'll probably never trade a bond contract in your life. You'll probably never trade stocks. You'll never manage your own self-directed IRA. I guarantee you there's some of us in here that are thinking that, and I understand that. I'm not twisting your arm to do it. But it is important for you to know what these asset classes are doing as a whole, and you don't have to be staring at them all day long. Periodically check them, see what's going on, get feedback from them. They should be moving in concert with one another. There's an ebb and flow that is necessary for the markets to be highly efficient, and when they're efficient, they create big moves, large moves, exaggerated moves, big ones, big, huge, profitable market moves. And they're easy to see coming, as we outlined this week. I took a chance on some things in the last couple weeks, and I was primarily working off of an intraday 4-hour chart to come away with my analysis. And I said, you know what, I'm going to spend some time with the S&P and not even look at the FX market last week. And it forced me to have a period of time separation from FX. And then Saturday when I did my analysis, as I normally would do, but I'm slammed. There's a lot of slides this month. There were 200 slides in the presentation. It doesn't take 5 minutes to do that. Some of you folks think that it's real easy for me to do it, and I thank you. I thank you for that vote of confidence that you think I can do these things in 5 minutes. I can't. It takes a lot of work, a lot of effort in designing it and bringing things together to make it, user-friendly. But I had a member send me an email saying that, I rushed out of here this morning, eager to go on vacation, and I promised to do a U.S. dollar CAD trade. And no, I didn't promise to do a dollar CAD trade. I promised to look at the market, and there would be probably a trade Friday with a dollar CAD. But using the asset classes as a whole, all 4 of them, I didn't see a trade this morning. And there was no trade this morning. It was a Z-Day consolidation ahead of a large, widely followed U.S. holiday next week, but a lot of folks go on the sidelines. By seeing all 4 asset classes, looking at what they've done, going into this morning at the time of this recording on Friday, June 30th, 2017, there has no real indication of what the market should be reaching for. It had already met my objective for the week. It already traded down to the low I called for and went just a little bit below it. So it's fulfilled it. If it's already met that target, what am I going to trade? Just because it hit the target doesn't mean it's going to go reverse in the other direction. I didn't feel it could go lower based on looking at all four of the asset classes, looking at the targets on individual currencies, the bond market. All these things work together. Some of you don't trust the level of experience I have in terms of time using this information. You watch a slide, you think you know everything, so therefore it has to be this. It's got to be black or white. And I've said this ad nauseum. It's not black and white. There's times when the market will appear black and white, when it seems easy, it's so obvious that it's going to go one direction, and those times will trick you because you'll think that it should be like that all the time. And this is the difficult part about trading. You have to work those times when it's like it, but when it's not like it, you need to dial it back. And the way you be able to determine those conditions is by rating the market in terms of risk on and risk off. And you can't get that adequately enough by just looking at one instrument, one pair. You have to look at the whole universe of speculation. Currencies, commodities, bonds, and stocks. This whole month was designed to draw your attention to the importance of knowing what all of them should be doing and what is it you should be looking for. Going into the marketplace, not looking for trades per se, but looking at the commodity market as a whole. Are commodities going higher or are they going lower generally? Are interest rates going up or are interest rates going down? How's that affecting the dollar? Is the dollar going up or is it going down? What's going on with equities? Is equities finding an ease to rally, or is it struggling to rally and holding more of a consolidation? All these things matter. They weigh out in the grand scheme of things in terms of feedback. Some of you are learning this for the first time. You've never had any kind of technical analysis, indoctrination to the marketplace. There's nothing that you've ever done. This is the first time you've ever done it. And your heads are spinning. Some of you that have been trading for a long time know that there are periods in the markets where it just gets really hard and you can't do anything right. And some of you think that you've traded before, got lucky, and you think you know what it is that should be happening in this mentorship. And you already had your opinion. You came in with a preconceived notion about what it is that you should be getting out of it, and you had no idea what you're going to be learning. It's the same individuals that have discounted this month's content, feeling it as, well, it's something apart from FX, so therefore it's not important, when that's the furthest thing from the truth. Intermarket analysis is absolutely crucial to you understanding what is going to be taught next month. Don't you want to be in the asset classes and those leadership on the upside or downside based on the things that have been taught thus far? Don't you want to focus where all the large institutions are going to be pouring money into it? Because they're the ones that's going to explode. They're going to be moving huge, fast, lots of distance, magnitude, the velocity of these types of moves. That's what you're looking for. You want to find them. And in between there, you want to be able to breed a bread and butter type trader. Find consistent setups here and there. Low resistance liquidity runs. One shot, one kills. Low risk, high probability day trade. Swing trade. Give me something I can hold for a couple months. But if you don't understand the relationship of all four of these asset classes and what those asset classes should be speaking to you when you look at them, that's what I focused on this month. I didn't give you a top-down, here's the crack course on trading commodities. First notice day, last trading day of the month, contract rollover, I didn't go into all those things. I went and talked about the most salient, important things from each asset class. That's it. Notice what I taught. The likelihood of a directional move per asset class, and the importance of knowing what to look for and when it should happen. What happens when you start seeing just two of the four asset class doing one thing, but the other two aren't doing as they should? Is that a very symmetrical market? No. But what happens if we start seeing a third start doing it? Well, that's now very interesting, isn't it? Because it brings us to the question of, okay, it's been uncertain now, but now we have a third asset class starting to behave as it should. So we're starting to come out of this chaotic uncertainty. So therefore, more of smart money's money is being put to work, because we are just the flea on their back. They're the big dogs, not us. We're never going to be a big dog like they are. They're large corporations, banks, institutions, insurance companies, pension funds. They're deep pockets, folks. And if you haven't figured it out yet, that's what I'm hunting. I'm looking for that. And if I can't find them, if they're not leaving clear tracks, I'm keeping my hands in my pocket. You know, that doesn't look good as a mentor sometimes. It doesn't look good as a rock star trader. But what do you think I've been doing for the last 20 plus years? Just keep staying in the game. That. Because if I don't do that, just like if you don't do that, you won't be around here 20 years from now. You won't be here next year. Maybe you will. Looking at something else, insisting there's something else out there better for you. Listen, if I'm not teaching it, it's not important. If I'm teaching it, it's important. I don't have enough time in the day to add stuff to what I already do. I don't have that. The time is not a luxury for me anymore. So I made a promise to everyone that I was going to teach everything that I know, and what makes me tick as an analyst when I look at price, what makes me believe that price is going to behave a certain way. Why do I think it's going to go up to that level? Why do I think it's going to go down to that level? Why do I think it's going to go sideways? Why am I avoiding trading? Like today. Because of my experience knowing what these asset classes are going to do ahead of a weekend, ahead of a holiday, even though the holiday is not Monday, not Friday, today, it's next Tuesday. And I know by experience what that will do to the markets. And I saw signs of it across all four asset classes today. Early. And because I had to do 2 videos today, and I had to do your PDF slides, all those things require time. I'm not trying to hide the workload. I can't hide it. It's a lot. I got to do it. But I can only do it in the 24 hours with sleep and eat and do the things that a normal human being will do. And you're going to have to find the time to do those same things in your trading. You got to take a peek at these 4 asset classes. You may not want to do it. Maybe your business that you're running, it's wore you out. But why are you going to trade without having a greater understanding about what the market should be doing as a whole? That's nonsense. It's foolishness to do that. So while you may never be a stock trader, or trade commodities, or even trade a treasury bond, it's important for you to understand what they are doing. What's their seasonal tendency? Are they behaving seasonally? Because if they're not, that means that we have a decoupling. And it's going to be hard for the markets to find a one-sided move with great deal of magnitude. And I'm not saying you won't see trades. It's just you won't see really strong moves like we outlined this past Saturday that we saw come to fruition beautifully across many pairs. All of our targets were hit. And they weren't small moves, they were large moves. And it comes by way of looking at all 4 asset classes. Listen, if you don't want to do these types of things, hey, I'm not going to twist your arm. You do what suits you. I'm here doing what I said I was going to do. But for you to understand what the PDF files from the top-down work will give you in August, you need to start thinking about these 4 asset classes, because there's reference points that you have to know in relationship to what they should be telling you about the general market as a whole. This is my suggestion. This month has a lot of teachings, a lot of lessons. And I want you to go through this again. And I want you to try to ferret out the points of discussion that I have for each asset class, and then try to draw parallels to it, because if you start doing that, you'll see where I'm leading you to with the PDF files in August. It won't be to the minute detail, but you'll have a general understanding. That way, when you do go through the August templates, you'll have that moment of astonishment where it goes, oh, I got it now. I see it. I see it now. Now you'll go back to the June content and say, oh wow, now I know exactly why he was talking about that, why he was showing this. And then you'll feel silly that you felt that this was a waste of your time. So until next time, I wish you good luck and good trading.
What did I do? Exactly what he said.
More money in your pockets, safer communities here in Wisconsin, and government that works for working people. Check out my website to learn more about what we're doing for you in Washington. Paid for by official funds authorized by the House of Representatives.
Isn't trading really just the same as gambling, except in the stock market? That's a question a lot of people...
Folks, when we talk about the commodity markets, it's very important that you read these disclaimers. Everything that's being discussed in this segment of our discussion on commodities, any trade discussion or idea or concept should be used is the raw data. Now, it's by www.cftc.gov. And what you want to look for is you want to be looking at the futures contract only in the short format. And if you do this under the CME, which is the Chicago Mercantile Exchange, we can find the currencies that trade as COMDOLs. And one of the COMDOLs are Japanese yen. And this is the most recent short format commitment of traders report for the Japanese yen. As you can see here, this is just for the Japanese yen futures contract. Now, the CFTC website gives you the opportunity to pull up the options positions as well. I'm not concerning myself with that. I never concern myself with that at all. I look at only the futures positions, and you want to be looking in the center column here where it says commercial. And when you see that commercial area, it's going to give you a little column that says long to the left and then short to the right. Directly underneath that long column, you'll see that there is 143,450 contracts. That's the commercial long positions. And then to the right of that, underneath the short column, it's 76,426 contracts short. The way we get the net position is we subtract the two to get the difference. And if it's a positive number, it's net long. If it's a negative number, it's net short. In this case, we have 67,024 contracts long by the difference between the long positions and the short positions. So there's a net long position of 67,024 contracts long. Now, basically, this tells us nothing about their current hedging program. So what we have to do is have to look deeper and go behind the numbers and see what it is they've been doing. Okay, net traders position line. Have to look deeper. go behind the numbers and see what it is they've been doing. Okay, net traders position line chart. And with this chart, we can track the three main classes of traders. And again, you would find this on www.barchart.com. You've seen me use it many times in the past. And what you're going to be doing is you're going to be plotting a daily chart, and you're going to be including in the indicator portion at the bottom of the chart, you're going to be adding the net traders position line chart. And the duration you want to be displaying is at least 1 year's worth of price action. And the commercial traders are typically on barchart.com shown as the red line at the bottom of the chart. The large traders are shown as in a green line, and the small speculators are always shown in as a blue line. But when we look at this price action against the net traders position line chart, I want you to visually see the hedging programs by the commercial traders. Now, when I first got into trading, obviously my mentor was Larry Williams. Much like everyone else that's ever come across his material, he's like the godfather, if you will, of the COT data. So everything he mentioned in his 1970 book, How I Made $1 Million Trading Commodities Last Year, using the commercial information, that was like light years ahead of everything else. Naturally, everyone flocked to just looking at whether the commercials are net long or it's a net short. Much like everyone else, I found out by trial and error that it isn't that easy. You got to go in there and do some more research. I thought clearly by looking at the commercials, if they were buying, so therefore I had to be a buyer too. But because their nature of what they are as a participant in the marketplace, they are usually large corporate producers or users of commodities. And commodities like a dial is the same thing. Currencies are a commodity. They're bought and sold. They're provided for in terms of allowing global commerce, providing loans, making transactions all over the world. And because there's a difference of all these countries around the world, there's going to be a change from one currency to the other to do business or make transactions in another country. So just like we would look at, for instance, like cocoa for Hershey, where they make a large production of chocolate, every day, their number one, supply and demand, the price overall.
Auto insurance all seems the same until it's time to use it. With USAA, it's easy to.
Between today's present date of June lines above the zero line from December of 2016 to present time, June 2017, that means that the commercials have been net long for over 6 months. So what does that mean? You buy, only just buy? It doesn't mean you just buy. There's other things you have to look at. But by itself, it means that they are in a buy program. Okay, so there's a buy program, and then there's hedging programs. The buy program is a macro perspective or macro program where they focus the bulk of their buying, and while they'll hedge and sell some, they'll be hedging in prices by selling. The shorter term buy program can be seen by looking at the 12 to 6 month duration. So in other words, we look back a year to see what they've done, the highest net long position and the lowest net long position they've had, and the lowest net short position and the highest net short position they've had. So we break the market down in two categories. What was their action above that zero line as a whole? What was the highest reading and the lowest reading while above the zero line? And what was the highest reading and the lowest reading below the zero line? So there's a buy program when they're above the zero line and a sell program when they're below it. But there's also hedging that goes on, commercial hedging programs that we need to be aware of, and you can track them by using this information. But you have to look at it differently. You can't look at it like this because this is what retail sees. Obviously, retail isn't going to have the true perspective on what price is doing from a commercial or institutional perspective. So what I have to do is change your perspective on how we look at it. So let's take a look at it closer now. So, okay, what we're focusing on here is the bottom of the chart. These three lines here, again, they represent, the green line is the large speculators, big large funds, or big private traders that have a lot of position size.
Small speculators is the blue line. That's usually the public. They have no idea what's going on. And then the commodity commercials, or large speculators, in terms of like a commercial user or producer of a commodity. In this case, if it's a bank, okay, or a lending institution, they would be in that red line. So the red line is really what we're going to be tracking. We're only interested in that line. We don't care what the green line is, because it's always going to be diametrically opposed to the actions or positions of the red line. And the blue line we could care less about, because that's the street money, less informed crowd. So what I've done here is I've removed, okay, by way of paint. And you can do this if you want to, but it's not necessary. Once you understand the procedure or process that you go through by looking at price, you won't need to do this. Over time, your eye will be trained to be able to look at this and be able to see it on its own. And you'll know just by looking at a standard net trader position chart, it'll jump off at quick first glance. You'll see exactly what's going on without having to do all this, acrobatics I'm going to show you with removing the lines with paint. It's not necessary, but I'll say this before we go into it. For those individuals that really want to have this data and be able to use it like this and see it graphically, you can start collecting the data, and you can download historical data for all the commodities that you want to track. And for those individuals that are in here that are only interested in the currency markets, if you like your favorite pairs, just download historical data about the net trader session for that particular currency. And for instance, say it's the Japanese yen, you want to be a specialist in. You can download years worth of data on COT data and plot the commercials net long positions and net short positions, and it would look like this. You could plot it with Excel, something like that. And I'm certain some of you guys that are really crackerjack with programming for MT4, you could probably create an indicator that does this, where it plots the net trader position for the commercials only. That way you can get a range and determine what the highest high and the lowest low is in the last 6 months and the last 12 months, and be able to get that range to define that, like we're going to discuss here. But without having to do all that, it's not necessary. But if you want to do it, there's things like that you can do. But what I do is I quickly look at the chart and I see it as I'm going to outline it here. So obviously we have about a year's worth of data here, and you can see the red line is the commercial activity. And right in December, right before actually December, right like the last week of November, you can see they swung from net short position below the zero basis line to net long in the last week or so of November 2016. Then they've remained above the zero line from that point on to now. So again, by itself, it doesn't tell us anything, and this is the reason why people walk away from COT data. They say it's useless. It's always hindsight. It can't be used in terms of being able to have prognostication about what price is going to do. And we're going to dispel that disbelief in this teaching here. So what we're going to do is we're going to focus on when the market's below the zero line. Okay, so zero line basis below zero is when the net position is bearish or short. The position above the zero line, okay, or the net zero sum basis, is going to be bullish, okay, or the net long.
Nationwide has strategies built to help you save time.
It's a game changer.
Their timely market insights help simplify conversations with your clients. But sometimes actions speak louder than words.
Crushed it.
With Base 44, a simple sentence becomes your website.
When we have those conditions, there's going to be things that we can do to look for optimal trade entries. Okay, not optimal trade entry pattern, but for optimal trade conditions for entries. So we're going to look at this price action segment here, and I want you to follow along with me, okay? And we're going to look in this whole portion of price action a lot closer and use this information. Just like we see it here on this chart, we're going to change it slightly in terms of the perspective, but we're not manipulating the data at all. We're just really zooming in and looking at it from a hedging perspective, because there's a hedging program that I want you to see in price action that you can track with this net sum zero line, and whether the commercials are net long or net short, and the activity of their net positions. Okay, so this is January 2016 all the way to January 2017. Okay, and what we're going to do is we're going to take this entire price action and we're going to divide it in two segments. We're going to do the first portion up to January of 2017. We're going to start around, beginning of the year 2016. I'm going to break that down. But before we get into it, I want you to look at what price was doing the whole first half of 2016. If you were looking at that, and obviously we have the benefit of hindsight here, but for the sake of argument, looking at institutional order flow, were the bullish order blocks being respected, and were up close candles, or what would be deemed as a bearish order block, were they being broken? In other words, are we seeing price being supported by discount arrays? Clearly, beyond a shadow of a doubt, it's there. So we know the institutional order flow was bullish from January 2016 or February 2016 when price made that low, and all the way through until around the mid-July going into the summer months. There was a small little pullback that broke a short-term low, and then price resumed higher again, and it had a lot of issues with getting above the 1.00 level on the Japanese yen, which we'll look at the end of this teaching why it struggled with that level and finally reversed. But we can see how institutional order flow was bullish. Every time a short-term low was taken out, price rallied. Anytime a price traded down into a down closed candle, it was supported as a bullish order block. And all of the premium PD arrays were always broken through. There was no premium effect that was lasting. But if we look at just the COT data down here, the commercials, the red line, that was below the zero line. So that would be telling us to do what? Go short based on the traditional perspective of commitment to traders. And this is why everyone discounted Larry Williams stuff for a long, long time, and still do today. And if you look at how I'm going to show you how to use this information, it takes COT data to light years ahead, where everyone else doesn't even see it like this. They don't even they don't interpret price like this. They don't interpret COT data like this. But this is exactly how you track what their hedging programs are. So while they had a sell program because they're below the zero line, or the zero line basis was bearish because they were below zero line from February 2016 all the way to the last or middle week of November 2016. You can see that graphically with the red line going above the zero. So while they have a bearish or sell program going on at the time for many months, they were selling heavily, okay, as the market was rallying. They were keeping sell program active, but you can still see institutional order flow being bullish. Now, this is what's going to confuse some of you, okay? We're going to cover the details later in this teaching, but for now, what you're focusing on primarily is what is the institutional order flow telling you. It's going to tell you whether there's buying or selling going on by price action alone. What we're going to do is decipher that from a COT standpoint, okay, and add that filter process. Even though that the COT data is below the zero line for many months, okay, we can still ferret out when the commercials step in and do aggressive hedging and buying, even though they're in that below the zero line or a sell program. You can see when they get aggressive and buy and cause price to go higher, while still keeping the COT data below the zero line. So anyone tracking the Commitment to Traders report for the Japanese yen, they're not following along. In other words, it doesn't look germane to them. It's completely alien. It doesn't make any sense. The Japanese yen's rallying, but they're holding a net short position by the commercials. How can that be? Well, why is that happening? Well, the commercials, again, they could be banks. They could be selling currency, providing liquidity. All that's being reflected in these numbers as a net basis. So just because they're below the zero line doesn't mean that we can't see buying and sell as well, because it can happen on both sides of the marketplace. But anything above the zero line, that's obviously bullish.
If you have tried a prop firm challenge and failed, or you've never had time to try it, listen to this. We pass the challenge, manage the account, and we work towards your payout.
And we would have to consider anything below the zero line bearish. But we do not limit ourselves to just focusing on selling only below the zero line or buying above the zero line, because you can do both. The way you decipher it is, what is institutional order flow at the time? What are the conditions right now suggesting in price action? If bullish order blocks are being supporting price, any lows that are being taken out reject price as a stop run on sell stops, and then all of a sudden it rallies and breaks through what would be otherwise deemed as a premium array, then institutional order flow is bullish. And you can see buy programs kick in the hedging program while a larger sell program is underway. And again, let me rephrase that. A larger long-term sell program can still have bullish hedging buy programs in it. And you'll see that now as we go through this segment of price action for the Japanese yen. Okay, so what I have here is I have price trained in on that segment of price, and I removed the large speculators line and the small speculators line, so that way we can highlight all of the price action by way of the net traders position line chart on the commercials, which is the red line here. Now I want you to see how price stayed higher, going higher, making higher highs, and finding support at bullish order blocks, running out short-term lows and then rallying, but finding their way through any high or premium array. So the institutional order flow all the way through to the middle of August going into September was bullish. But how do we reconcile this net short position by the commercials? Because they're below the zero line. It doesn't make any sense unless we break it down and use the 6-month range and the 12-month range idea of looking for the highest and the lowest reading on their net position by the commercials. We don't care about what those long-term speculators that are in the blue line. We don't care about the small specs. We don't care about the large specs. We're only caring about what the actions of this red line is, because it's going to show us and reflect what their hedging program is at the current time. So anytime when you're looking at COT data, you want to look at where we're at right now and go back 6 months, because there's your 6-month hedging program. They have a 12-month hedging program. So by blending the two, you can get short-term quarterly effect trades. Now think what we talked about that. There's quarterly effects every 3 or 4 months. There's a shift in market structure, and the market trades in a sustained move for about 2.5 months or so, maybe 3 months. But every quarter or so of the year, there's a shift in market structuring, and this helps you find that by looking at the 6-month range of the highest high and the lowest low the commercial net position has been. That is seen with this shaded area. So you can see the highest high and the lowest low is being basically blocked out with that shaded area. So once you know what that is, you divide that in half. You get that range. So we can go back 12 months and in 6 months intervals. But in here, you can see how the net positions have stayed in a very tight range. Even that can tell us a gold mine worth of information. Look what suddenly happens when you decipher the information like this. You do not see COT data like this, and Larry Williams doesn't even do this with COT data. This is something I looked at price forever, and I knew there was something going on behind the scenes. And I literally said, you know what? If price can trade in trading ranges, so can this information. But if they're going to be doing buying and selling, it can't be hidden. If that's true, I should see it if I look at the data in terms of the range or time. Remember IPTA? Well, I applied similar things to this. So I looked at 6-month intervals and 12-month intervals, 3-month intervals, 4-year intervals, 3-year intervals, 2-year intervals, 1-year interval, and then 6-month intervals. So if you go back through the data and you look at it like that, you'll get a clear depiction of what the commercials are actually doing. Now, if you look at these green little nodules in here, okay, even though that we're below the zero line, by determining the total range in the last 6 months and the last 12 months, we can get every time their hedging program kicks in, even though there's a larger sell program is underway by keeping the net positions below zero, their hedging program can be deciphered by looking at these little nodules once you determine the range. The first one here, you can see how all that buying took place. The second one here, you see where they made a low there, bought off of a bullish order block that was seen in the last week of April, filling in a void. And we have this area here where they were buying again after we've taken out a short-term low. It was seen in the last week of June, and price resumed, but then found long-term resistance at that 1.00 level, which we'll look at the last slide of this presentation, and you'll see why clearly that had a struggling point there. And the program is underway by looking at these little, all that buying took place. The second one here, you see where they made a low there, bought off of a bullish order block that was seen in the last week of April, filling in a void. And we had this area here where they were buying again after we've taken out a short-term low. It was seen in the last week of June, and price resumed, but then found long-term resistance at that 1.00 level, which we'll look at the last slide of this presentation, and you'll see why clearly that had a struggling point there, and we're finally reversed by breaking a short-term low, only after trading at that 1.00 level a few times, failing to get above it, and finally breaking market structure to a downside. And then you can see the commercials finally started building up a larger net long position above the zero line. So their zero line basis is now bullish. So now they're in a buy program. But they're going to be hedging early. They start doing it early, but they make the highs and the lows in the markets by doing that.
Chew into it with Extra.
Managing trades emotionally in the middle of one is the biggest problem people have. They protect profits too early.
But they make the highs and the lows in the markets by doing that. So now we're going to look at the last week or so of November 2016 all the way to present time. And again, I'm going to counsel you to look at what the COT data looks like by plotting a net traded position line chart, as everyone else would do with the information that you would get with commitment trades reports. This is what it would look like if you zoomed in on a daily chart. Again, it doesn't tell you much except for the net long. And granted, they have been sending the Japanese yen higher as a result of that. But what was institutional order flow as well? Are down candles supporting price when it trades back down to it? Are up close candles being broken as PD arrays? Are old highs being taken out? And are we seeing support by price moving down into what would be otherwise a discount array? Yes, we're seeing that all throughout this entire price segment from the midpoint of January, the midpoint of December, going into January, where we made that turning point. Now commercials have really moved to a net long position. Now they're in a buy program. But now, because we're in a buy program, does that mean it can't sell off? No, it can have sell-offs, but we're going to focus primarily on what is the range the last 6 months, okay, of the commercial activity. But first, we got to focus on what that looks like. So we're going to take everything down to just the commercial line, and I removed the small specs line and the large speculators. Did not manipulate the price or do anything with the indicator. All I did was erase everything with paint so that way we can clearly see what's going on. I want you to look at, by taking that information, determining the highest high and the lowest low in the range, defining that basis line, creating its own new basis line, we can see where the buying kicks in, and you see nodules kicking in January. We can see one in mid-March, and we can see one in the last week of May. And those are the respective time periods where the market sees the greatest advances in price going higher. All through here, market was bullish. All through here, we're currently bullish as well. If you look at the price of Japanese yen right now and go to the left in the last week of April of this year, you can see there's a fair value gap up there at 91.50. So it kind of gives you an insight about where we think, based on what we're talking about here, where Japanese yen might go, at least on the short term. And we're using the hedging program, as outlined here, as a basis for that. So when we look at commercial hedging, we're not looking just at whether they're net long or net short, but that does give us the buy or sell program that they're operating in. But inside that buy and sell program, or buy and sell program, I should say it like that, there are hedging programs that go on, because their nature of their speculation in the marketplace is to lock in good prices for their manufacturing of commodity or a good, And to do that efficiently, they have to make sure prices are obtained at very discount or friendly levels. You know, you don't want to be buying, if you're Hershey, you don't want to be buying cocoa later on when you've already seen fundamentals are suggesting it's going to be higher 6 months from now or a year from now. You're not going to be doing all your buying then. You're going to allocate a lot more money now to buy up stock for that, so that way when prices go higher, you've made a better return on your investment and keeps costs low. And that's the nature of hedging. So the same thing happens with the banks and lending institutions. You know, the value of money is going to be fluctuating all the time. So their trained accredited staffs that do those types of things, they will invest and buy and sell based on those notions that they're supply and demand factors that they have an assessment on. I'm not smart enough to know what they are. I've never claimed to know that, and you're never going to know that from me because I don't know it personally. But I can see what they're doing graphically, and they can't hide it from me. And now, because I've shared it with you, you can do the same thing. There's nothing that they can't hide it from you. There's nothing to worry about. They're not going to be able to hide in the future because you now know how to do it. It's just the data. While Larry Williams back in the 70s and 60s, you know, he had it figured out then, but only at extremes. And that's what I'm going to say in closing here. When we look at the Commitment of Traders report and we plot on a trader's basis, whether it's a net long or net short on the commercials, if we get to a 4-year extreme or a 2-year extreme or a 12-month extreme, generally there's usually a long-term trend reversal at play. And the commercials will sometimes factor that in with their own movements in the marketplace. By having those extremes, we will discount any short-term hedging program if we get to a 4-year, 2-year, or 1-year extreme of the highest high and the lowest low of their net positions. But let's look at this segment here, again, a little bit closer, where the commercials were below the zero line, and this section over here where they're above the zero line.
With USAA Safe Pilot, I can save when I road trip safely.
Or with USAA Safe Pilot Miles, I can...
When we see those conditions, okay, the red line, that's a sell program. The red shaded area, when it's like that, below the zero line, that is a sell program. Doesn't mean you can't see buying going on, but you have to look at it in the form of the hedging program that goes on. Look for the small short-term ranges, and when they go above the new range that you would define, as we just mentioned and outlined a moment ago, you can see where their buying and selling is taking place. Below the zero line, the best conditions are looking for shorts. That means if you can get institutional order flow bearish, you want to look for net short positions by the commercials and at premium arrays, and that would be the ideal scenario. But you can still get buy hedging programs inside that long-term sell program. And again, I know this is going to confuse some of you, but you're going to have to watch this video several different times, because you're going to see, by looking at it multiple times and listening, you'll see that there's two factors taking place here. Long-term buy and sell programs based on the zero line, whether above or below it, and then they hedge even during those periods, because they're not just buying all one time and selling all one time. They're moving back and forth in the marketplace around specific price levels. When they create these nodules in the hedging program, those levels are significant in the future. They're going to be key price points as a PD array. Make sure you have that in your charts and note them by using the COT hedging program technique that I just taught you here. In the green shaded area, that is ideally going to be seeing the best buys when the market is creating discount arrays and institutional order flow is bullish. But it doesn't mean you can't be selling short when the short-term 6-month or 12-month range indicates that the commercials are net short in the new adjusted range. As in other words, we looked at the last highest high and the lowest low in the last 6 months and 12 months. Even if they're above the zero line, while that's a bullish buy program long-term, they could still be doing short-term selling hedging programs in there, and it causes price to go lower. But you have to look at things in terms of blending 3 different things. You're looking at the program of buying and selling, whether they're above or below zero line. Then you look at the hedging program based on the range of the highest high and the lowest low of the commercials in the last 6 months and the last 12 months. And then using institutional order flow, what is price telling you? Is it respecting discount arrays or premium arrays? And by blending those things, you can get to the truth of what the market's actually doing, and you'll know what institutional order flow is with the greatest of confidence. So commercial hedging programs, if commercials are above or below the net sum zero line, both sides of the market can be traded. The current range of the commercial's net position is referred to. If institutional order flow is bullish, we're going to be blending discount PD arrays and the last 12 or 6 month net long commercial readings for long trade. Now, again, that's when we see those little bullish nodules in the new defined range. Again, this can be ideally seen when we're above the zero line. If institutional order flow is bearish, we're going to be blending premium PD arrays and 12 or 6 month range of the net short commercial readings for short trades. The best conditions are seen when both net sum basis agree with institutional order flow and PD array matrix confluences. PD array matrix confluences. The long-term commercial activity. The net sum zero line delineates the net buying and or net selling. Now, retail traders that know about the net trader position chart only look at whether commercials are net long for bullishness or net short for bearishness on the market. The smart money can be tracked by focusing on the 12-month and 6-month range of the commercial net position. If the commercials are above net zero line, we're going to be focusing on the 12 to 6 month net long readings. If commercials are below the zero line, we're going to be focusing on the 12 or 6 month range net short positions. We blend these conditions with PD array matrix and institutional order flow for optimal results in directional analysis. So with this teaching, what we've done is we were able to decipher what the commercial actions are, whether they're buying or selling, and not relying so much on whether they're below or above bearishness on the market. The smart money can be tracked by focusing on the 12-month and 6-month range of the commercial net position. If the commercials are above net zero line, we're going to be focusing on the 12 to 6-month net long readings. If commercials are below the zero line, we're going to be focusing on the 12 or 6-month range net short positions. We blend these conditions with PD array matrix and institutional order flow for optimal results in directional analysis. So with this teaching, what we've done is we were able to decipher what the commercial actions are, whether they're buying or selling, and not relying so much on whether they're below or above a zero line as everyone else interprets price using this information. Looking at that 100 level here, we can see how price went back to the 2014 January highs and July highs and cleared out those equal highs and fell short from that position all the way down to a level that was seen as a discount array in the January 2016 time period. This is a weekly chart, so everything that we teach in terms of PD arrays, institutional order flow, all those things get blended together to get optimal results, and now you've entered the inner circle as it relates to hedging, commercial activity, and COT. Until next time, I wish you good luck and good trading.
Vibe coders, ready to build more? Meet Base 44.
Looking at that $100 level here, we can see how price went back to the 2014 January highs and July highs and cleared out those equal highs and fell short from that position all the way down to a level that was seen as a discount array in the January 2016 time period. This is a weekly chart, so everything that we teach in terms of PD arrays, institutional order flow, all those things get blended together to get optimal results, and now you've entered. Welcome back, folks. Again, we're dealing with commodities, so it's very important you read the disclaimers here and understand and remember that I'm not a CTA and not a commodity trade advisor. Everything we discuss here is only referring to a paper trade capacity only. Okay, welcome back. ICT Mentorship, June 2017. Commodity Trading, lesson number 2. We're going to be talking about relative strength analysis, and we can see professional accumulation and distribution.
Okay, when we deal with commodities, there's two main camps or groups of markets that make up the commodity market, and it's the agricultural and the financial market. The first in the agriculturals are the grains, and I'm gonna tell you the ones that I like to follow, and there's other grains obviously like oats and such, but I'm not going to concern myself with that. The grain markets, we have corn, wheat, and soybeans, and they trade on the Chicago Board of Trade, and it's an exchange for the grain markets. And there's other grains that can be traded, like
Chew into it with Extra.
If you're an unprofitable trader, it's not because you lack discipline. It's probably not because you're
canola and oats and something like that, but they're very thin markets. But these are the three that I historically, as a commodity trader back in the early 90s, these are the three I actually started to follow a lot. Out of the livestock sector of the agricultural markets, we have feeder cattle, lean hogs, and live cattle. Out of the foods area, we have cocoa, orange juice, which is kind of thin, but I include it when it's really a freeze, like in Florida. If there's an issue with the crop down in Florida, it's a really fun market to be trading in. But otherwise, orange juice is kind of thin, but I include it because it is one of my favorites to watch for that very reason. Coffee and then sugar. And in the fibers, we have cotton. Now there is lumber market, but it's kind of thin as well. And out of the financial instruments, we have the debt instruments, which is the 30-year Treasury bond, 10-year Treasury note, and the 5-year Treasury note. The currencies. The condyles here we see Aussie dollar, Canadian dollar, Japanese yen, British pound, Swiss franc, Euro dollar, and New Zealand dollar. The metals, we have gold, silver, and high-grade copper. Now, there are two other metals, palladium and platinum, that I did follow early on in the 90s, but I just fell out of interest in it, and these are the three metals I like to follow. And in the energies, obviously, we have crude oil. So when we look at the commodity market as a whole, this would be your basket of commodities to follow. Now, much like Forex, there's a nice sample size to choose from, which one you want to be trading and which one you may want to be a specialist in. I liked the treasury bond in the currency markets and dabbled in gold and silver and copper when there was a real strong tendency for it to move. In the agriculturals, I liked soybeans, wheat, and feeder cattle and live cattle. And on a seasonal tendency, I like the lean hogs. I traded cocoa, orange juice, coffee, sugar, and cotton. So when we look at the commodity market and we look for relative strength analysis is basically factoring your analysis around the most important market to be following right now when you're bullish and the most important market to be following when you're bearish. And there's really two simple ways to come to the conclusion of what that is. As you know, the dollar index is like the king. Okay, so the greenback is the king. So what the dollar does sets the tone for everything else, especially when it comes to commodities. So if we look for the dollar index to be trading higher, that's going to put pressure on the commodity prices. If the dollar index is going to be trading lower, that's going to allow and incite higher commodity prices. So when we look at this, I want you to think in terms of that scenario. So when we look at institutionally sponsored rallies, what we're actually looking at is a market that has failed to go lower at a time when the dollar index would be expected to go lower. So in other words, if the dollar is making some important high or maybe even a topping formation, that may be a precursor to a bullish commodity market. And the commodities that you'd be looking to be long in are a commodity that fails to make a lower low, which is basically an SMT divergence. So what we see here is in the graphic diagram on the right hand side is underlying price strength. Now this is what you want to classically see when you be buying commodities. What you're seeing is when the market tends to trade higher energetically as a leader market, it establishes the underlying direction that's opposite to the dollar index. Now these markets are extremely profitable, and our aim is to focus on these particular commodities to trade because they're going to be the strongest upside movers. Short-term highs are going to be seen broken, and declines are going to be shallow in nature. Every time price makes an upswing or it makes a up-closing candle, they're typically much larger than those that close lower or any short-term swings that move lower in price. The key is you want to be focusing on the commodities that fail to make a lower low. They're basically diverging with the dollar index. So if we see that, we know that there's a professional accumulation, or in this case, institutional sponsorship for buying. If the institutions step in, and because they're going to be buying a whole lot more, because their institutional volume is much larger than a speculator would be like you and I, that will facilitate the market rallying higher and showing unwillingness to go lower, because there's a large degree of buying coming in. Well, there's the supply and demand factors that are coming into force with the commodity. They're not going to permit price to go lower, so it will fail to make a lower low when the dollar index makes that higher high. You have to understand what the dollar index should be doing as a whole, though, because it may not be so clear just by looking at higher highs and lower lows in commodities. When one diverges, it doesn't necessarily mean that there's a trade. You have to have the analysis on your dollar index, because that's going to set the tone for a prolonged move. If the dollar's going to weaken, that's going to provide at least a intermediate term basis for the commodity market as a whole to rally. But not every commodity is going to rally. This is what ferrets out these strong moves, and which is why we say it's relative strength analysis. Relatively speaking, a commodity that fails to make a lower low like this, it's stronger because it has failed to make a lower low. So when the dollar drops or shows weakness, this particular commodity, whichever one it would be that creates this this condition or scenario, that's the one we would be looking for bullish ideas to unfold in.
How confident are you in turning your vision into value? We helped develop a growth and operational strategy that enabled a pharmaceutical company to establish a global footprint. Solutions that work in practice, not just on paper.
At Spectrum, we believe you shouldn't have to choose between speed, reliability, and value.
Now, as we just discussed in the beginning of this teaching, I've broken down the agricultural sector. sector and the financial sector of the commodity markets. So we have a basket of commodities that we can follow in two divisions. One, the agricultural markets, things that are grown or living, okay? And then we have the synthetics, the things that are man-made or created or manufactured or drawn from the earth that don't breathe, okay, like oil and energies. So by having those two divisions in the commodity markets, we have a nice basket of choice to make. If there's a bias to the market as a whole for the commodity market to go higher, that means that the dollar index should be going lower or expected to go lower. Not every commodity is going to go higher. The ones that fail to make that lower low, that's the one we are really focusing on, okay? So that's really the heart of this teaching. But as we saw, there's different groups of commodities, like the livestock, and then there's the grains, there's currencies. When we see those little groups of types of markets, like, again, all the meats, like feeder cattle, live cattle, and lean hogs, those three make up the livestock group. One of those meats may fail to make a lower low when the dollar is starting to go lower. And when it does that, it's showing leadership. For instance, it could be the live cattle market. And feeder cattle may not have that higher low form. It may make a lower low, like it's being described here graphically on this chart. And maybe lean hogs makes a lower low as well. But live cattle makes that higher low we just showed in the previous slide. Institutional sponsorship behind that particular commodity would send live cattle much higher and a lot more magnitude and speed, because you can see that they're buying that one up. The other meats or other commodities and other groups that may not show those evidences of a higher low when the dollar's weakening, that would be seen as this, and you would be seeing a sympathetic rally, okay? And what we're seeing is typically a commodity that makes a lower low, but the meats should make a lower low.
You, just you, building your app on base 44.
So when the dollar drops or shows weakness, this particular commodity, whichever one it would be that creates this this condition or scenario, that's the one we would be looking for bullish on the basket of. commodities that we can follow in two divisions. One, the agricultural markets, things that are grown or living, okay? And then we have the synthetics, the things that are man-made or created or manufactured or drawn from the earth that don't breathe, okay, like oil and energies. So by having those two divisions in the commodity markets, we have a nice basket of choice to make. If there's a bias to the market as a whole for the commodity market to go higher, that means that the dollar index should be going lower or expected to go lower. Not every commodity is going to go higher. The ones that fail to make that lower low, that's the one we are really focusing on, okay? So that's really the heart of this teaching. But as we saw, there's different groups of commodities, like the livestock, and then there's the grains, there's currencies. When we see those little groups of types of markets, like, again, all the meats, like feeder cattle, live cattle, and lean hogs, those three make up the livestock group. One of those meats may fail to make a lower low when the dollar is starting to go lower. And when it does that, it's showing leadership. For instance, it could be the live cattle market. And feeder cattle may not have that higher low form. It may make a lower low, like it's being described here graphically on this chart. And maybe lean hogs makes a lower low as well. But live cattle makes that higher low we just showed in the previous slide. Institutional sponsorship behind that particular commodity would send live cattle much higher and a lot more magnitude and speed, because you can see that they are buying that one up. The other meats or other commodities and other groups that may not show those evidences of a higher low when the dollar's weakening, that would be seen as this, and you would be seeing a sympathetic rally, okay? And what we're seeing is typically a commodity that makes a lower low but starts to trade higher sympathetically, so we have sympathetic price strength. Now this is going to be a market that tends to trade higher in sympathy to the leader market that establishes the underlying direction. While these markets are potentially profitable, again, our aim is to focus on the leadership markets for the strongest rallies. Now, short-term highs are seen broken and declines are shallow in nature, and the upswings and up-closing candles, much like we saw with the institutionally sponsored rally, they're typically going to be larger than those that close lower or move lower. So if you're trading a commodity that has the characteristics that's being described here, you're not actually buying the relative strength leader on the buy side. You're actually buying a sympathetic rally or the sixth sister of the group, okay? And not that you can't make money doing that, because you can see that many times those moves will be moving in sympathy and moving in tandem, but at a lesser degree in terms of speed, magnitude, and it will be more lethargic. It may get to objectives that you trade and reach for, but not as strong and as quick and as efficiently that you would be seeing it with the leadership.
Passing a prop firm challenge is easy. Staying funded, that's where 95% of traders fail. And if
in sympathy and moving in tandem, but at a lethargic ship. Obviously, the opposite is seen here. institutionally sponsored decline. It's a market that tends to trade lower energetically as a leader market and establishes the underlying direction opposite to the dollar index. These markets are extremely profitable, and our aim is to focus on these markets as they'll be the strongest downside movers. Short-term lows are going to be seen broken, and rallies are going to be shallow in nature. Downswings in price and or the down closing candles are typically much larger than those that show with a closing higher or upswing in price. The key on this, again, much like we saw with the institutional sponsored rally, is the focal point of the failure swing to make a higher high. When that dollar index is bullish and it's about to rally, that's going to put underlying pressure on commodities as a whole. Not all the commodities are going to drop. The ones that fail to make a higher high, they're going to be leadership on the downside. So they're going to be showing underlying price weakness. Okay, much like we saw with the sympathetic rally, we have a sympathetic decline. This is a market that tends to trade lower in sympathy to the leader market that establishes the underlying downside direction. While these markets are potentially profitable, again, our aim is to focus on the leadership market for the weakest declines. Just like we saw with the sympathetic rally, we can see short-term lows are being broken and rallies are shallow in nature. The downside swings and down close candles are typically much larger than those that close higher or the moves higher. Just everything reversed when we saw for the slide for the sympathetic rally. Basically what we're seeing is price weakness in a sympathetic nature to the leadership. Again, I'll use this analogy. Say the soybean market was the leadership issue on the downside. It failed to make a higher high. While the grain complex should be moving lower as a whole, say wheat makes a higher high and corn makes a higher high, but soybean makes that lower high. Well, soybeans is going to be the outperformer on the downside. Doesn't mean that wheat and corn won't decline, but it will be doing so in a sympathetic fashion like we're describing here. Again, we're focusing on the weakest of the commodities to sell short, and the way you determine that is by looking at their highs. The commodities to sell short, and the way you determine that is by looking at their highs. Alright, so let's go through the commodities as a basket, and we'll start ferreting out what we see generally when the dollar index is giving us indications that it wants to move higher or lower. First area of business is the middle of 2016's summer, we saw the dollar rallying up into January 2017, making a high. And then we saw post January 2017, we've been seeing continued weakness on the dollar. So from the middle of the summer of 2016 to the beginning of this year, 2017, we would expect to see commodities going lower while the dollar has been moving higher. And then obviously commodities from January to the present time of this recording, June 2017, we should be expecting commodities to rally or look for leadership issues to fail to make lower lows, and then look for opportunities to be a buyer as a paper trader in those particular commodities. And that way you'll learn how these commodity markets work. First one we're looking at here is corn. We're going to go through the agriculturals first. And corn is our first grain. And you can see that from the middle of 2016, we saw the decline in corn, as we would expect with a higher dollar. And down below the August and September lows, you can see corn kept making a lower low, which was underlying weakness, while the dollar index was making higher highs. The corn market showed a willingness to go higher off of a higher low. So we had a failure swing going into the latter portions of December 2016. But we had extreme weakness shown in the move down. But December into January, we saw that higher low form, and the market went relatively sideways. Small little modest move from 360 up to 390, which is only a 30-cent move. In this case, it would be about $1,500 per contract. So that's actually a very weak market. The grain market for this specific commodity, corn, was weak. We didn't see any kind of leadership buying in here at all. The wheat market, much like corn, we saw the wheat market, much like corn, we saw this slide down from the summer months, making lower lows, and then making a lower low even in December going into January. So we had continued weakness on wheat. This grain stayed in a consolidation as well. Failed to make any kind of real significant rally higher, and its underlying weakness was seen in price action. Soybean price action. Soybeans, we saw the summer decline going into August, but then August and September and October, we started seeing the soybean market fail to make lower lows, while we saw the dollar making higher highs. So there was already indications that the soybean market was under accumulation because it was failing to go lower. In the second week of November going into January 2017, we saw soybean market trade down with a higher low, and I actually talked about this during the mentorship. If you go back in the January time of our time together, you'll actually see me talk about that and mention those equal highs that were around that 1080 level in this chart. And price rallied up, and we saw relative strength in the bean complex. So soybeans across the grains group was the leadership issue. So soybeans were strong. So if you were looking to be a buyer in January when the dollar index was making significant reasons to look for a lower move in the dollar, that's going to allow commodities to rally. Soybeans in this case rallies about $4,500 per contract in terms of a move. The next one, we're going into the livestock group now. Just like we saw in the previous commodities, we saw the decline from the summer months going down into the fall, end of the year. But then we started seeing some accumulation. seen in the middle of October going into the first week of December. So while the dollar index was making higher highs, the feeder cattle market was failing to go lower, so it was already showing signs of accumulation. If it's not going lower, there's only one reason for that. That means that they are under accumulation and they're buying it. Who is? Institutions are. Large traders, big players. So they're buying up feeder cattle. And notice that we're seeing short-term highs being broken and more short-term highs being broken. And then at a later time in March, when the dollar creates another intermediate term high and starts to sell off, we have that February-March time period where the feeder cattle market trades right back down into a bullish order block. So we have the accumulation pattern seen here, but early signs were already shown that they were accumulating the feeder cattle market. Feeder cattle actually developed a premium, which we'll start teaching later on in this week, but the price of feeder cattle actually went, in this case, parabolic, and it was very strong as a result of that, because we saw price show signs that it's wanting to not go lower. It was breaking short-term highs. It was under accumulation, and then at a later time when dollar index was ready to sell off again in March of 2017, that provided another buying opportunity for feeder cattle. Notice also the last half of February going into March, the dollar index was making higher highs around that 102 level. But that last portion of February going into March on feeder cattle was making a higher low. Again, that same accumulation pattern is being seen there, but it's also occurring in a previous bullish order block. So we're blending PD arrays discount with the context that we should be seeing higher commodity prices. This one fit the bill because it had everything in favor for it. What does it translate into? This move here, from the buy all the way to the high, is over $19,000 per contract of a move. Not too shabby. Per contract of a move. Not too shabby. Alright, the next one in the livestock complex is lean hogs. We saw the decline from the summer months going down into September and October. And then October, November, and December, we started seeing accumulation patterns again. Market was failing to go lower while the dollar index was making higher highs. We've seen clear accumulation patterns in the lean hogs market. Later on in 2017, we had another opportunity for the dollar index to sell off, trade up into a premium array, building a liquidity void. Price trades lower on the dollar index, which is going to allow bullishness for commodities again. We can see in the lean hogs market, the market trades back down into a bullish order block, and we have a subsequent parabolic rally from the 68 to 81.5 cents for lean hogs, and that means about $5,600 per contract. Last one in the livestock group. Means about $5,600 per contract. The last one in the livestock group is live cattle. Price trades down from the summer months into October, making a low, and then from October going into November and December, we see accumulation occurring again in here. While the dollar is rallying, the live cattle market is failing to go lower, so they're under massive accumulation. Same scenario we said earlier with the March high in the dollar index, creating a sell-off. There's a buying opportunity in the live cattle market. Trades down into a bullish order block, rallies away, and again, much like we saw with the feeder cattle market, live cattle futures were very, very strong. It translates to a move of $12,000 per contract. All right, now we're going into the foods, and the first on our list is cocoa. Cocoa is clearly under a lot of distribution. It had a bumper crop. There was no real shortage of cocoa, and there was no impulse for the supply and demand factor to be swung to a shortage. So there was lots of supply of cocoa, which provided this consistent decline on the price of the cocoa futures. So we have no real indication that this is under any accumulation whatsoever, and our analysis comes away with cocoa is very weak. It's not under accumulation, so this would never meet the criteria as a buy while the dollar is dropping. Coffee, same scenario. We saw weakness, market making lower lows in December going into January as well. We had a nice little pop up, which is a nice little retracement, but it overall kept in sync with the weakness that was seen. So coffee here was weak as well. And sugar, was weak as well. And sugar is our next one. Again, we see in November going into the middle of December, we see sugar making lower lows. We have a small little divergence at the lows that saw a rally up, but when we got back up into February, March, that found its weakness after coming up into a premium array or bullish order block around that 2050 level. And just could not find any more bullishness. So in this case, we can see kind of like a mixed signal. So you could have looked at it as weakness, and then the last little portion of December going into January, that higher low, while the dollar index actually made a higher high. It's a divergence. That would be a failure swing. So that's why you see that move higher up in sugar, but then it ultimately falls over and can't find any more continuation. So I want to provide you opportunities where, in realistic terms, you're going to be able to see these things, but then you're also going to see things that start off like a good move and then fail. And that's what real environments are going to be like for you. So in this case here, sugar was weak. Okay, we're in the So in this case here, sugar was weak. Okay, we're in the fibers group, and we only have cotton in our basket of commodities to be worrying about. The slide from August down in September, after an initial rally, trades back down into a bullish order block. At September, dollar is rallying, cotton's not going lower, and you start seeing successive higher highs, higher lows. Every short-term high is finding its way broken with no problem at all, and bullish order blocks are supporting price. So we can see clearly that this commodity is under accumulation. So in this case here, cotton was a very strong commodity at the time when the dollar was weak. As a result, the move that transpires is over $8,000 per contract. The move that transpires is over $8,000 per contract. Okay, now we're in the financials. We're looking at the 30-year Treasury bond, and I'm actually going to talk a lot more about bonds in the bond trading week. So you're going to see something in this chart that, if you're a student of mine, obviously you're going to know right away what it looks like and what we should be talking about. But we're going to keep in general terms just for the commodity portion of this this month. So we see the market making lower lows here, underlying weakness. And the bond market has been weak. We've only really traded in a consolidation, haven't really made any significant moves higher, which has been the catalyst, I believe, that why the markets are so fickle right now. We've had so many issues with finding sustained moves in the foreign exchange market, and it's going to be translated by looking at the chart here. You can see clearly that the market for the bonds have been range bound, and they haven't really moved much at all. And then we have the 10-year notes, same thing. We see underlying weakness. 10 years is weak as well, and we only saw a consolidation transpire since then. And a consolidation transpired since then. And 5-year notes, we actually saw weakness and then further weakness in March, and we've consolidated since then, so nothing's really happened in the debt instruments. And again, interest rates are what makes the markets go around. So if you're a currency trader, it's going to put a damper, if you will, on how we see sustained moves in the currency markets. Speaking of currencies, okay, the first on our list is the Australian dollar. Looking closely, look at the highs on the dollar index going into January. We made that higher high in the dollar index. We made that failure swing to go lower on the Australian dollar. If you go back in the January month, you'll actually see me talk about that very particular thing. There was weakness seen in the dollar index at those highs, and we saw accumulation come in on the Australian dollar at those lows. Incidentally, Australian dollar was strong with a differential, so the interest rate differential was a bonus for this one, so that's why we saw this nice extrapolated move to the upside. The next one on our list is nice extrapolated move to the upside. The next one on our list is Canadian dollar. Now this one here had basically an equal low, and it started off with basically a modest bullishness to it, but finally gave up the ghost in February and rolled right back over and followed suit with the dollar index, which again is kind of weird because the dollar index and Canadian dollar moving together makes it difficult. Alright, so we have the Japanese yen next. Alright, so we have the Japanese yen next. Again, look very closely at the dollar index. We made a higher high going into January, but we have the higher low in the Japanese yen. That's the accumulation that's seen by way of institutional sponsored rally. So we can see the market was making short-term highs, breaking those short-term highs, and order blocks that were bullish were being supporting in price. So yen in this case was very strong. So this was our leadership issue as well. For the currency market, so it's Australian dollar and yen so far. Okay, we have the British pound here. This one has been lethargic. We have a slightly lower low going into January from October. No real accumulation in this pair at all until we got around to the March time period, when March creates the high in the dollar index. Then we saw the opportunity for the cable to start rallying from that 122 level. But overall, the pound market has been weak. Okay, the next one here is the Swiss franc, and look closely. Again, you'll see that failure swing. So we have institutional sponsors that rally, higher low when the dollar index makes a higher high. Weakness in the dollar index should see the foreign currencies rally. They're calm dolls, they should go higher. In this case here, we see this weakness in the dollar index should see the foreign currencies rally. They're calm dolls, they should go higher. In this case here, we see the Swiss franc do that very thing and go higher. And at the March time period, when we saw the dollar index create a high, we had another intermediate term low on the Swiss franc, and it rallies again. And then in May, last month, where we saw the dollar index trade up and close its fair value gap as a premium array, the Swiss franc creates a turtle soup long and closes in its fair value gap seen in the month of March, and then rallies higher. So we have a very strong Swiss franc as a result. So we have the Australian dollar, the Japanese yen, and the Swiss franc as our leadership issues. And then we have the euro dollar. We have a higher low also on this currency. So this one here, we look and see we have short-term highs being broken, and all premium arrays being broken on the upside, and then supporting price at the discount arrays. So every bullish order block, we see price being more accumulation and more rallying. So euro was very strong here as well, and more rallying. So euro. Euro was very strong here as well. And last in our group of currencies for the COM dolls, we see one more instance of a currency that had a differential. The interest rate differential was a plus for this one as well. So, in other words, if you buy the New Zealand dollar in Aussie, it paid you a interest rate for holding onto it for carry trade purposes. And those two currencies were actually the leader of all the interest rate differentials at the time for this beginning of this year. And with this higher low, which is institutional sponsored rally, at the time when the institutions were looking to sell short on the dollar index in January, made a higher high in dollar, did not see that lower low we would expect in the New Zealand with a differential as well. So here was Kiwi as an upside leader as well. Okay, moving over to the metals. Okay, we have another similar situation here where the gold market was failing, and we talked about this in January too. Gold was failing to make a lower low, so we have institutional sponsored rally when the dollar index was making higher highs, and as a subsequent to that occurrence, we see all the bullish order blocks providing support to price, and premium arrays being broken as price moves higher. Gold, in this instance, was a strong commodity to be a buyer. silver started the same way gold did. Higher low, institutional sponsorship rally, and price was reaching through premium arrays. Bullish order blocks were supporting price until we got up around that 1850 level, and it fell out of bed. It came all the way back down, but traded a bullish order block at that 16 level, which I talked about at the time of the decline. If we got down to that level, it'd be an interesting buying opportunity. And we've since then rallied 168 points, so almost $7,000 plus per contract if you were looking to trade that 16 level. But it was my modestly strong here. And as a side note, I actually was very, very bullish on silver, much more than gold. But for whatever reason, it failed at the 1850 level, and the storyline changed from that point on. Okay, the last metal we're going to look at is high-grade copper. And you can see the accumulation that was really underway in September and October, failing to make a lower low. And finally, this exploded on the upside. And copper here was a very strong metal as well. And copper here was a very strong metal as well. And finally, for the energy complex, in our commodity basket, we have crude oil. And crude oil was failing to make lower lows as the dollar index was rallying. And this particular energy was under accumulation around the $43 a barrel mark, and then finally rallied up. And you can see crude oil was a strong commodity as well. So what we've done is we've gone through all the commodities, and we used relative strength analysis to ferret out the leadership issues when the market should be seeing commodities trade higher. Notice that all of them did not trade higher, but we were able to go in looking at price action, no indicators, no bells and whistles, just simply understanding what the pattern looks like when large institutions step in and buy. What does that pattern look like? It's that failure swing. It's the fact that short-term highs are being broken and premium arrays are not respecting anything in terms of offering resistance. It's being broken through, and then all of the discount arrays are supporting price. Everything that we've shown here is reversed when the dollar index is bullish, and we would be looking for bearish ideas in commodities, and we would go through the commodity markets and look everything that we did here just in opposite terms. But for agriculturals, what we've done is we ferreted out the leadership from the grains. It was the soybean market. Out of the livestock, all three of them did well, but feeder cattle was by far the absolute leader. Feeder cattle actually developed a premium, which we'll teach later on in this week about, and we'll actually use it as an example as well. But the feeder cattle market was the upside leader. On the foods, notice there was an absence of really anything that lent well for a buying opportunity. Out of all the foods, they were all relatively weak. The fibers, where we have lumber is in that group, but we don't look at lumber because it's kind of too thin in my opinion. Cotton was an outperformer on the upside as well because it was underneath professional accumulation. So we ferreted out 1, 2, 3, 4, 5 markets out of all the agricultural markets. Our trading patterns and price action analysis concept helps us find where the leadership issues are going to be as a buying opportunity. Financials We didn't see anything in the debt instruments, and I've been saying this all year long, which is the reason why the markets have been
Factor working review. Housing.
for 5 markets out of all the agricultural markets, our trading patterns and price action analysis concept helps us find where the leadership issues are going to be as a buying opportunity. Financials, we didn't see anything in the debt instruments, and I've been saying this all year long, which is the reason why the markets have been pretty much next to untradeable. The currencies, we see that Australian dollar, the yen, the franc, the euro, and the kiwi were all upside leadership. In the metals, all 3 of them did very, very well here. Silver was the weakest sister of them all, admittedly, but gold was the outperformer in my opinion. We did have a lot of strength on copper, but you only had one real opportunity to get in that one. So that's why I'm saying gold was the outperformer, because gold gave you a couple different instances to get in. And lastly, in our basket of commodities is crude oil, and we saw that one also provide a nice opportunity to be a buyer. Nothing really to compare it to. It used to be heating oil and unleaded gas and natural gas I would look at when I was actually looking at commodities as a major asset class, and that was the only thing I was trading at the time. But if you're going to have a basket of commodities to watch, I think this is a very good one. It's well balanced, and it gives you a nice universe to work within. It gives you an ability to work within multiple groups to look for leadership issues. And as we indicated and shown here in this teaching, not all commodities are equal. They're not going to perform the same. You have to have tools and concepts to go through and as a process, eliminate the ones that are not performing as you would expect in price action, and focus on the ones that are giving you that fingerprint hallmark signature that there is huge accumulation underway and or distribution. So by using this concept, it will help ferret out all the better moving opportunities when the markets are predisposed to go in one direction or another. Until next lesson, I wish you good luck and good trade. 2012, and we see. Welcome back, folks. Again, opinion. We did have a lot of strength on copper, but you only had one real opportunity to get in that one. So that's why I'm saying gold was the outperformer, because gold gave you a couple different instances to get in. And lastly, in our basket of commodities is crude oil, and we saw that one also provide a nice opportunity to be a buyer. Nothing really to compare it to. It used to be heating oil and was the upside leader. On the foods, notice there was an absence of really anything that lend well for a buying opportunity, which we'll teach later on in this week. Out of the livestock, all 3 of them did well, but feeder cattle was by far the absolute leader. Feeder cattle actually developed a premium, which we'll teach later on in this week about, and we'll actually use it as an example as well. But the feeder cattle market, they were all, lumber is in that group outside as well, because there's under 2, 3, 4, 5 markets out of all the agricultural markets. Let's find where the lead one goes underneath professional accumulation. So we ferreted out one where we have relatively weak. The fibers, where we have lumber is in that group, but we don't look at lumber because it's kind of too thin in my opinion. Cotton was an outperformer on the upside as well, because it was underneath professional accumulation. Agricultural markets, it's fine. Financials, markets have been. The current Europe, 3 of them did very, very well here. Silver was the weakest sister of them all, admittedly, but gold was the outperformer in my opinion. We did have a lot of strength on copper, but you only had one real opportunity to get in that one. So that's why I'm saying gold was the outperformer, because gold gave you a couple different instances to get in. And lastly, in our basket of commodities is crude oil, and we saw that one also provide a nice opportunity to be a buyer. Nothing really to compare it to. It used to be heating oil and unleaded gas and natural gas I would look at when I was actually looking at commodities. The currencies, we see that Australian dollar, the yen, the franc, the euro, and the kiwi were all upside leadership. In the metals, all 3 of them did very, very well here. Silver was the weakest sister of them all, admittedly, but gold was the outperformer in my opinion. We did have a lot of strength on copper, but you only had one real opportunity to get in that one. So that's why I'm saying gold was the outperformer, because gold gave you a couple different instances to get in. And lastly, in our basket of commodities is crude oil time period. So let's test that out on the understand that everything we say here is all specifically talking about paper trading only. Okay, folks, welcome back to lesson 3. This is June 2017 ICT mentorship, commodity trading, lesson number 3, seasonal tendencies, my personal favorites. Okay, we're looking at the first on our list, and we're going to be talking about the agricultural markets first, and then we'll go into the financials. But before I begin, I want to, number one, stress that panaceas don't exist. Be-all, end-alls don't exist in trading, and certainly seasonal tendencies are not one. While my personal belief is that there's validity behind them, because of human error, because of the seasonal tendency not taking effect of the time of a trader sitting down and trying to implement them, just know that you can lose money if you try to place all of your faith on seasonal tendencies. But my personal interpretation of seasonal tendencies are, it's like a roadmap or like a treasure map, if you will. It kind of like gives me the normal expectation of what should normally be seen in price action that time of year. Now, anything can happen, obviously, with agriculturals. There could be a drought. There could be a bumper crop, meaning there's a lot of supply, and a drought would create a short supply, and demand would go up, and obviously the prices would go through the roof. But when we have these seasonal tendencies, again, it's important that we remind ourselves, like I did when I mentioned them earlier in the mentorship, that they're not panaceas. They are not going to be absolute, but they're good roadmaps as to what to expect for each individual, in this case, commodity. So the first in our list here, the seasonal tendency for the soybean market. On the left hand side of every slide I show you, I'm going to present the seasonal tendency on the left, and then a weekly chart of the last 5 years, so that way you can look at price and form for your own opinion whether there's any validity to having these seasonal tendencies in our toolbox at all. I believe by your study and your interest, by seeing whether these things come to fruition or not in the old data, I think you'll come to the conclusion, like I did, that there's something going on that, in my opinion, provides validity and not entire trust, but certainly one to look for reasons to expect the market to perform as we would see in the seasonal tendency. If we don't see the market trading in line with the seasonal tendencies implying, that actually gives us insight as well. So if at a time when it should be bullish, for instance with the soybean markets, usually the 1st of February going into the June time period, usually the bullish time period for soybean market. But if the market's actually trading lower, what is that telling you? It means seasonally and influences are not under influence at all. They have no impact at all on price, and there's probably something underlying that's heavily slanted towards a big supply of soybeans. And otherwise, the normal function for higher prices and markup in the price for soybeans isn't being seen. So if we're seeing bearishness during the first
half or so of the year, that means there's probably a whole lot of soybeans, that's available, and there's going to be so much supply that demand won't push prices higher. But if there is a condition where we're expecting bullishness, like we see here in the first half of the year generally, if that occurs and we are in a primary bull market or other reasons that would support bullishness are seen in price action, then we can look for the seasonal tendency to support a sustained move going into the middle of the year. Interestingly enough, June time period going into July creates a seasonal tendency to create a high. And then usually it trades down into the September-October time period where it creates another seasonal low. If we look at the top of every one of these seasonal tendencies, you're going to see a small little yellow box here. And the first in the series from left to right, you see MAR, it stands for the March delivery contract for soybeans. The next delivery contract, when March contract expires, you can no longer trade that contract. You have to trade the next month, which would be May. When May expires, you have to trade July. When July expires, you have to trade August. When August expires, you have to trade September. When September expires, you can trade November. When November expires, the next month would be January. Obviously, you want to always try to trade the first or nearby month because that's where all the open interest is generally. There's a few commodities that don't always operate like that, like gold usually has a tendency to skip a month in the latter portions of the year. But the easiest way to do is go into the barchart.com and you pull up the contracts that you would be doing your analysis on. Just look at open interest and volume. Whatever has the highest one, that's usually the contract you're going to be looking at or looking to trade. On the seasonal tendencies, there's two lines. There's a solid black line, which delineates 40 years of price data. So that way we can look at the seasonal tendency pattern for the last 40 years. And Steve Moore, who creates this wonderful resource, also plotted a 15-year seasonal tendency pattern. And the reason for doing that is when we have a short-term view of a tendency or data, and you compare it with a longer-term sample size, like 40 years contrasted with 15 years of the same information, if there is a strong seasonal tendency there, that means we should be able to see it both in the short-term 15-year data and the 40-year. And you can see, by contrast, the heavy solid black.
Fuck. I could just be smoking pot and chilling. I could. Watch the sunrise. Delineating city both are plotted because make sure market discrepancies.
Line, red line, pretty much the same direction. So when we look at the seasonal tendencies, we're looking for that criteria where both of them agree to create a high or low and sustain moves. So in this case, for soybeans, we can see the 1st of February, there's a seasonal tendency for soybeans to rally going up into the mid portion of the year, June or July. And then June, July, we create a high and trades down into September, October, creating another seasonal low. On the right-hand side of every one of the slides I'm going to provide you in this teaching, I am not doing any markups at all, because I do not want to give the impression or imply that these seasonal tendencies are absolute. I'm not trying to overprove them. I'm only suggesting that you look at the data and you tell for yourself whether there's any validity to it. Okay, and don't just use the last 5 years data like I'm showing you here. Go back as far as you possibly can and see if these things do in fact materialize. And I think you're going to be rather surprised when you see how consistent many of them are. So we know that there is a seasonal tendency for price for soybeans to rally around the beginning of the year. So we can look for the January delineation at the bottom of the weekly chart on the right hand side, and we should see price rally up into July. And if you look at January 2013, follow that up with your eye, you'll see there's a low and it trades all the way up into July of that year. Very phenomenal, very, very consistent with the seasonal tendency. Then in July, we expect price to trade down into a fall, September, October time period. And it creates a seasonal low in October and consolidates a little bit and then rallies again in January of 2014 into the June month, creating a high for 2014, trading all the way down into what? Yep, you guessed it, the September-October low for 2014. The 2016 time period, you can see that the seasonal influence for price to rally for soybeans comes into effect again, making a high in the month of June of 2016, then trading lower, making the low in October. So I'm going to counsel you to weigh it out for yourself whether or not there's a seasonal tendency here. So if we are a commodity trader in the making and we want to paper trade and see if there's any validity to these things, we know that there are strong tendencies to trade soybeans 3 ways. Look for longs from February going into June, July. Look for shorts from June, July down into September, October. Look for longs September, October going into the following rotation in the summer months. Now that may break up into 2 stages or 2 legs in price action. That's how you use the seasonal tendency, or at least how I interpret it and how it's served me well over the last 20 years. The next seasonal tendency is Chicago Board of Trade wheat. Now this one's a little funky, but when it's there, it's solid. There is a seasonal tendency for wheat to decline the first half of the year and then make a low second half of June and in August. So we have a little bit of a time period between 4 to 6 weeks where the low could form. And if we look at the July time period on the weekly chart, you can see that there's generally a rally like in 2012. You can see the rally in wheat. And in the 2013 year, we saw price decline a little bit. That year didn't have the seasonal influence for bullishness there. Same thing with 2014. And in 2015, we saw the market rally going into the July time period. And in the 2016 time period, the bullishness was also not seen as well. And this year we haven't got to July yet. We can see clearly that the wheat market has been in a strong bearish market. And now, by using that seasonal tendency, let's look and see if there's any influences for sell-offs from the beginning of the year in January going down into June. So we can find the first January in our weekly chart is in January 2013. Follow that line straight up, and you can see there was a high formed around the $8 a bushel, and price traded lower. As a result, down into, yes, the July time period. And in 2014, we actually seen the price only decline for about a month in January 2014, then it rallied. Then the following year in January 2015, we seen price decline a little bit and traded down into what looks like May, and then May created a low and started to rally. In 2016, we saw the market decline, and while it did have a retracement above the $5 mark, it did trade down into a low of the July-August time period. And in January 2017, we did not see a decline. We actually saw it rally. So there's times when the seasonal tendency will not be of any significance at all, won't have any impact on price. But if we ever see the wheat market go into a bull market, the best times to be a buyer that I've seen in historical price action, you can see it for yourself, is to look for a low in the July-August time period, and then in November. So November and July-August, they're the best times to be a buyer of wheat. When markets are in bear markets, like we've seen in the wheat market here, if wheat is in a bearish market, best times to look for sells is the beginning of the year going down into summer months. Chicago Board of Trade corn. Okay, so the best time to be looking for shorts, obviously you can see it jump off of the seasonal tendency chart here, is in May. May and June create seasonal tendencies for corn historically over the last 40 years, and it usually drops down into September, October time period of the year where it makes a seasonal low. So we can check this by looking at the April time on our weekly chart and find an April and see if it declines down into September, October. So the first one we can see in 2013, it creates a a little bit of a retracement, but falls out of bed in July down into the October time period. Then in April of 2014, it creates the very high of that particular year, trades down into October, September, October, creates the low. Then in the following 2015 year, we can see that April has a decline. It does rally a little bit early in 2015, creates a high and sells off again, but can't get below the 350. And actually 350 stays a support level for a number of months going into 2016. So we don't see any decline in April, we actually see it rally. And that's actually strong, because what we're seeing is the seasonal tendency for corn to actually be declining in the spring. It can't. It's finding support off of a historical $3.50 a bushel price mark. And it rallies up and challenges an old high seen in July of 2015. Then price creates a low in the September time period when we expect a low. And that's been seen in 2016. And corn has been steadily moving sideways to slightly higher since that price point. And we didn't see any decline. Notice that in April, May of this year, we've actually seen corn go higher. So that I think we have a little bit of a sleeper market, meaning that we might see some bullishness for the corn market, because it's not abiding by its seasonal tendency. So if it's not doing that, what is it telling us? Underlying relative strength. Okay, the next one is feeder cattle. If you eat hamburgers, this is where it comes from. If you're wondering what a feeder cattle is. Alright, so if we look at the seasonal tendency for this commodity, it usually makes a seasonal low in the April-May time period. It can occur as early as February. If you look at the dashed red line, in the last 15 years, there's been an impulse to create a seasonal low as early as February, but generally, the best moves, as you can see in the dashed line, it really starts to move higher at the end of April going into May, and it creates some seasonal high in around August and September. Then it goes in consolidation. So how do we use this information? It's ideally a good time to be a buyer in the spring and sell it going into the fall. So if we can find April and look for basically October. So between April and October, there should be a rally. So if we look at the April delineation for 2013, we can see the market rallied, in fact, from that spring time period all the way up into the October high of 2013, nails the short-term high, then it consolidates, just like the seasonal tendency does. Then in 2014, we see the rally going all the way up into the very high of the feeder cattle market in October 2014. Then in April 2015, we see price rallying again, but it falls out of bed a little early. So in August of that month, or that year, we can see that it had already started to decline, but we still saw an impulse of price to move higher in the feeder cattle market after a long-term breakdown in market structure. And in 2016, we see price actually not see the seasonal tendency have any impact whatsoever because of the overall bearishness on feeder cattle. Then in this year, 2017, we can see that April created a nice little short-term low at the $1.30, and then it rallied, and we've since rallied up to 160, which is a phenomenal price move for feeder cattle. And we still may even go higher, but looking at what's already happened this year, it's been a nice rally from the 130 level up to 160. Every 100 basis points, or one full point or handle, is $500 per contract for feeder cattle. Okay, the next one is live cattle. This is what you get before you get a hamburger. These are the living, breathing cows. So the seasonal tendency for this commodity is live cattle. This is what you get before you get a hamburger. These are the living, breathing cows. So the seasonal tendency for this commodity is a high forming in the February-March time period and a seasonal low forming in June. So ideally, the stronger impulse is to see a low form in June. So there's usually a markup period seen in the middle of the year going into the end of the year. So it's real easy to use that information by looking for July, essentially on the weekly chart. Find July and see if that creates a low up into the January time period, so that way we can see the weekly chart. So find the July in 2012 and look at the January 2013. You can see it did in fact rally that between these two price points. Then in 2013, we can see that it did rally as well in June of that year, all the way up into the end of 2013 going into 2014.
That nigga went.
Then again in 2014, June, it creates the low of the year, and then it rallies incredibly, going up and creating the high of the year in what looks like November. And then in the following year, we had the market in a bear market, influenced by seasonal tendency. Didn't have any impact at all during the June-July time period, but the sell-off in February-March, starting in 2015, you can see that they actually called really nice shorts and tops in the marketplace. And as the market was bearish, the January, February, March time period each year was creating the really nice sell-offs as the market was bearish. And then we created a nice low in 2016 in the October time period, which doesn't fit anything seasonally, but we started to trade higher. And now this year we saw the market have a little bit of a decline in the February, March going into April, but then April, May, and June, we're seeing the effects of that seasonal tendency here with higher prices on cattle. So again, really strong seasonal tendency here. If you can blend it with technicals, it's a really strong one. The next one is lean hogs. Okay, if you like your bacon cheeseburgers, this is where your bacon comes from. Used to do pork bellies, but we don't trade those anymore. All right, so we're looking at the seasonal tendency for this one, and in my opinion, and please take this with a grain of salt, if you're looking for a seasonal tendency that is one of a dandy, this is the closest thing to perfection in terms of my ability to find and study things over historical data. This one here is a super one. This one is a buy in March, April, and in a high forming in May, June, down into a seasonal low of September and October. Okay, so primarily, if you're going to be a buyer of lean hogs, we're going to be looking for a buy around the February, March time period. Basically, we look for April on our weekly chart and just go to the left of it one line, and you should see a seasonal low at that time period. So we're going to look at 2013's April, go one vertical line to the left of the April delineation, and that's going to be March, and you can see that it nails the 2013 low, and it rallies all the way up into July, creates the seasonal tendency to high, and falls out of bed. The next year, you can see in 2014, we get a phenomenal opportunity to see February-March time period seasonal tendency rally. It goes vertical. It goes insanely high, way high. That is a millionaire maker. That right there is a mega trade. That's what it looks like. When you see types of moves like that, it's hard not to be pleased with a move like that. It's incredible. And the seasonal tendency high forming in July, well, look what happened in 2014. It nailed the high. Then in the 2015 time period, you can see the seasonal tendency as well occurs in March. It rallies up into the June-July time period, creates the seasonal tendency high, and falls out of bed. The following year, again, we see the March-April time period, creates the seasonal low. It rallies up into June-July, creates the high, sells off, goes down into September-October. And this year, we saw, again, the March-April time period seasonal tendency for lean hogs to rally, and it has done so in stunning fashion. So this one here is one of those best kept secrets. Traders that trade commodities, they probably never see this, but I can tell you, everyone that trades commodities professionally and they trade agriculturals, they trade this one every year. All right, seasonal tendencies for cocoa. All right, you like your cocoa, hot chocolate, you like your candies. Well, that's where we're getting it from, cocoa. So the seasonal tendency for this one here, while it's muddy a little bit, if you look at it, the best ones I see are a low to form May-June up into the September-October time period. So we're looking for a seasonal high to form basically the last week of August going in September and making a seasonal low last week of May going in the first week of June. So we can find July in our chart and go over one to the left, one vertical line to the left, and there should be a seasonal low forming, trading up into October time period. So let's test that out on the 2013 year. So we're going to look for the July of 2000. Well, I'll start on 2012, Michael. You can see that there was certainly a rally that traded up into the September time period in 2012, and we see it occur in 2013. We see it occur in 2014. We see it occur in 2015. There's a rally that we actually did a study on last year. If you were following me as part of the live session I was doing on YouTube, we did a case study on the cocoa market as a buy, trading up to that 3,200 and 3,250 level, which ended up becoming a pretty neat case study. We used some options in there, and even though it didn't trade long-term a lot longer, higher price move, it did go to what we were looking for, and we saw doubles and triples on our options as a paper trade. And in 2017, we're entering obviously the same type of thing here. We see cocoa rallying from the 1800 level up almost to the 2100 level. So we saw that same influence as well with the seasonal tendency. Okay, this one here, orange juice. This one has a strong tendency for September, October low to form and then rally. So basically the easiest thing to do is find in October and see if it creates a low and see if it rallies into December, or basically one vertical line to the January mark to the left. Okay, so you can see that rally did occur in 2012. It did occur in 2013. It did occur in one month late in 2014. Nailed it on 2015. Nailed it in 2016, and we'll have to see if it's going to do it this year. Okay, coffee. I liked this coffee market when I was a more active commodity trader. I don't trade commodities anymore, but when I was always following coffee. And this pair, when it moves, it can move a lot. And its best time to be a buy is June, July. You can see that this last 15 years, there's been a seasonal tendency for it to create a low in mid of June. But seasonally, over historical long period of time, 40 years, it's usually the month of July And if we go and look at every July, you can see that it does create a low in 2012. It doesn't create so much of one in 2013. Does nail one beautifully in the 2014 year in July, and doesn't do so much of a job of it in 2015. Does a wonderful job in 2016, and I'm almost certain we'll probably see one of those occur this year. So we'll be watching the coffee market going into the next month of 2017. For bearishness, the ideal scenario is to look for April-May high, and we can see by looking at a time when the market was bearish, April creates a April-May time period in 2013 as a nice sell-off there. It creates a high in 2014, sells off rather nicely there. And in 2015, when it was bearish, the April-May time period created a nice sell-off. Took a little bit of time lethargically, but it went down from this time of the year. We had a small little retracement lower in 2016, nothing of any real significance, but this year we have seen the April-May time period create bearishness for the coffee market, and we're seeing that here in price action. Okay, seasonal tendency next that ends our discussion for the agriculturals is cotton. A very strong one to sell off in the May time period. So we can look for the April portion of our weekly chart and see if there's any sell-offs from April. And you can see in 2013, a really nice sell-off for the 94 cents a pound in cotton. And it trades down to 80, so that's 14 cents. Each one full handle is $500 for this commodity. And the next one we have in 2014 creates the high of the year and sells off rather precipitously. Many handles lower. And in 2015, we had some consolidation, as you would probably expect after a big move like that we saw in 2014. It was in consolidation, but yet it still had a little bit of a sell-off where it moved about 400 basis points or $2,000. Then in 2016, we did not see so much of a high sell-off in April. We ended up seeing the low form, and it started rallying. So that actually shown how the bearishness that would be expected in the seasonal tendency for cotton in April, May, we saw it rallying, and that's going to be an opposing force showing you that if it's not following the normal business routine of selling off in the spring, it's showing you there's been a strong underlying strength behind this commodity, and you can see it's been straight up since then. And in the following year, we're now time of year this recording is 2017, we did not see a sell-off again either of any importance. We only saw like 300 basis points sell-off from 78 to 74, but it rallied precipitously going into the 87 cents a pound. Okay, first in our discussion of financials, we're looking at crude oil. Okay, first in our discussion of financials, we're looking at crude oil. Strong tendency in the beginning of the year to rally and creating a seasonal tendency high in the September-October time period. So we can look at January of 2013. You can see that it did, in fact, in this case, sell off a little bit. Didn't have the seasonal tendency there. But we did see a decline in the September-October time period of that year. Creates the high. And then we have, in January 2014, the crude oil market did, in fact, rally. Traded up into the month of June of that year in 2014, creating the high. And then it sold off rather aggressively. And we see in the following year, 2015, we see a seasonal tendency for it to rally, and it does. It does so for about 1,500 basis points. And then we see price in 2015, we see September-October seasonal tendency create a high around that $15 a barrel mark and trades down into the seasonal low that would be expected to see January of 2016. And price rallies all the way up into what we saw for the seasonal tendency outlined to the left, perfectly delivered. And then we saw price consolidating at the beginning of 2017 and then slowly dropping lower. So there's been no seasonal tendency support for bullishness in the first half of this year. Price has been going lower. So what is it telling you? There's a lot of supply on the oil market. So we're going to probably see oil trade lower because there's been no significance on the upside when there seasonally should be. Okay, the next one is the high-grade copper market. And again, this is kind of like wheat. It's kind of iffy. Best times to be buying copper are the months of June and the month of November. Best scenario for selling is September and April. Okay, so we're going to look for April to create a high. You can see that April sold off in 2013. It sold off in 2015, and we had a sell-off in 2016, and we had a little bit of a sell-off this year. For the long side, let's find the July time period and see if to the left of it for June creates a low. In 2012, we see it happening there. Seasonal tendency long. Seasonal tendency long for 2013 in June. That came to fruition. 2014, we had a little bit of a long also in copper. And in 2015, we did not have the seasonal low formation of the seasonal tendency buy that would be normally expected in June, July. 2015 didn't have it. Did have a sell-off in that year's September, so we had the seasonal tendency for bearishness come into effect. And in April of 2016, had a little bit of a sell-off, but it consolidated, and we've stayed in a range for the entire, basically the majority of 2016, and finally it rallied in the November time period, October-November time period of 2016, and then in April of this year we saw that seasonal tendency so far declined a little bit as well. So when copper goes into a premium, which we'll learn about in the next lesson, this is one of those metals that can do extremely well. And if it's bullish and the seasonal tendency says that June and November is a good time to be a buyer, and it has a premium, this market can really move. Okay, gold. This one's a really simple one. It's a buyer's market. So we look for the July-August low to form, and that's it. We don't look for anything else. You can look for a sell-off in January, February if you really want to be hard-pressed for a short, but generally the ideal scenario is to look for longs. And the reason why, all the jewelry that gets sold in the year of Christmas time and New Year's and all that business, it has to be obviously mined, it has to be stored, it has to be processed, it has to be turned into the jewelry and then put to market early enough so that way everyone can buy it, wrap it up, and put it underneath their tree by the end of the year for Christmas. So the seasonal tendency for gold is just that. So we're going to look for July to create the lows. So if we go into July 2012, lo and behold, we have a rally in gold, and we see a rally in 2013 in July. We see a high form in 2014. There's a rally that forms in 2015 in July. There's a rally that occurs in June, July of 2016 that ends up making a high. And then, well, we don't have July yet. July will be next month. So we'll see if we get that rally occur in gold. Okay, lastly, in our series of seasonal tendencies is the silver market. Much like gold, we're looking for July-August time period for a low, and silver can make a selling point in February. But we're focusing primarily on being a buyer of silver, because if this market does go into a parabolic bull market, which it tends to do that every 10 or 12 years, if you look at what we've been seeing here for long term, silver looks like it's poised to make a nice run, and it could go up to the 27s, maybe even 28s. You'll see why I was bullish in the time we've been spending together in this mentorship, why I believe this metal could have some real legs with it and go higher. Doesn't mean it can't go higher than 28 if it gets on a rip, but that's where I think it's going to go over the next 18 months or so. So, if we see the
seasonal tendency for silver to occur in the July-August time period. We can anticipate the July low to form. So we'll find all the Julys and see if there's a low forming. 2012, the low in July. 2013, a low in July. And there's a high forming in 2014. And there's a small little consolidation in 2015. 2016, we had price rally up and then create a high in July. And we are getting ready to have July this year for 2017. So we'll see if we have that bullishness of an impulse to send silver higher. That concludes the discussion for the seasonal tendencies, because I've already mentioned the commodities for ComDollars in our discussion earlier in this mentorship when I discussed all the seasonal tendencies for currencies and how they relate to Forex. I'm not going to use the bond market or debt instruments either, because I use those also in the discussion for seasonal tendencies. So these are the markets I like. There's other commodities that you can trade. Obviously, you can trade canola, you can trade rice, you can trade butter, you can trade milk futures, you can trade palladium and platinum, you can trade natural gas. So there's other futures contracts that you can trade, and obviously the index, which we'll talk about next week for June 2017 content. But for commodities, these are the ones I like to highlight. These are the ones I had historically in my basket that I like to look at. There were some quirky little things that I did with the thinner markets like canola and rice, where I would use the open interest decline on that to frame whether or not the grain complex was bullish or bearish. And back in the early 90s, I felt there was validity to that, and I actually used it in my teaching material then. Over the years, I've learned that that wasn't entirely true. It just means at the time, all the grains were going up because all commodities were going up. So it was a drought across the board in the 90s, and it just caused all kinds of problems for all the grains. So that's why they all went up. And any open interest decline, you know, I was erroneously attributing the open interest decline in canola and rice as supporting roles to why wheat and soybeans and corn should go higher. And that's not true. I used the same thing with oats. I would look at oats and I would look for the open interest decline there, and that would support bullishness for the grain complex. And I can tell you I was very, very wrong by teaching that stuff back then. I didn't know what I was doing. And now, because I've been looking at this stuff for over 2 decades, I know that open interest is directly related to only that particular market. After all, it's the open interest of that commodity, not something that can be shared an idea of. So I've learned over the years a lot about how these markets work and operate, and when I was on America Online, I thought I had everything figured out as an early neophyte. But I didn't have much of an understanding at all, actually. But in my opinion, these seasonal tendencies have held up very, very well over the last 20 plus years. I'm going to counsel you to come to your own conclusion whether or not there's any validity to them. The best way I can tell you to use them is use everything else we've done so far in mentorship, blend these things together. If we know that there's a seasonal impact for prices to move higher for a particular commodity, and you know which ones they are, every year when you get a calendar, okay, or you can just program it in your phone. If you have a smartphone, just put it in your smartphone, and at the beginning of every month, make a list of all the seasonal tendency influences that you should be expecting for that particular month. That way, every month when you sit down in your charts, say, okay, well, seasonally, this is a good time for this particular market to go higher or this particular market to go lower. And then go into your analysis and see, don't force it, but look and see if there's reasons to justify that seasonal tendency. Here's the wonderful takeaway. If it's not, basically following the seasonal tendency, it's telling you something. Either it's going into a long-term consolidation, which you can't make money with, or if it's not consolidating, if it's going the opposite direction, that means there's very significant strength. If the seasonal tendency is calling for lower prices and it's not doing that, it's going higher, it's actually telling you something. There's a strong demand for that commodity. Check and see if it has net long positions in the commercials. As we discussed so far in the beginning of this month, I gave you ways to look at the hedging program. Wait for them to go into a hedging buy program and go in and test your discount arrays and see if you can get any movement off of that. So hopefully you've learned something from this teaching. I can't tell you how richly these graphs have blessed my understanding of the marketplace over the last 2 decades, and I'm sure if you study them and hold them close to your heart like I did, they'll serve you equally well, if not better. And until next lesson, I wish you good luck and good trading. Welcome back, folks. Again, we're talking about commodity trading, and it's important that I remind you to read the disclaimers here. And I am not a commodity trade advisor. I'm not licensed to give trade advice. Everything that's mentioned in these topics referring to commodities are specifically to be viewed as paper trades only. Okay, folks, the June 2017 ICT Mentorship, ICT Commodity Trading Lesson 4, Premium versus Carrying Charge Markets, and this is going to provide you an X-ray view of institutional order flow. Okay, when we look at commodities, one of the best resources you have at your fingertips, and for free, is on barchart.com. And this is what you'll see generally when you click on a commodity, and it'll pull up the contract delivery months that it's available. And we find that by going to the select commodity tab over here, and you scroll down, and you find whatever commodity you want to do your analysis on. One of the things you want to do periodically as a commodity trader is once every 2 to 3 weeks, you want to be looking for markets that are developing a premium. Okay, it used to be when I first started as a trader, commodities would be listed in the newspaper like Wall Street Journal and Investors Business Daily. Not that they're not listed now, but that's where I would usually scan. I would look for a premium or a lack of premium in the delivery months. And we're looking at cotton here, and you can see that all the months that are available for trading for this particular commodity are listed on Barchart's website. Classically, what you'll see when we pull up, for instance, soybeans, and we're going to assume that the column that shows last here, that's going to represent the closing price. Now, obviously, at the time of this recording, I was getting prices, and they may not be representative of closing prices, so just for disclosure's sake. But we're going to assume for a moment that we were looking at the market after they closed, and we look at the closing price, or in this case, the last. And generally, if there's a cash market that could be seen for a commodity, they'll list it first on barchart.com, and that'll be at the top of the list. And then immediately below that, you'll see the first contract delivery month, or what is referred to as the nearby contract. The immediate contract month right after the nearby is always referred to as the next month out. So we want to be looking at the nearby and the next month out always, okay, in contrast to whether there is a premium. When there is no premium, we have what is referred to as a carrying charge market. Now, a carrying charge market is simply today's price viewed in the nearby contract. If today's price is $9.40 on the July contract for 2017 soybeans, we could see in August, the next month out, there should be an increase in that premium or closing price, and we see it here. So in July 2017 soybeans, closing price would be representative of $9.40, and in August its closing price would be representative of $9.43 and 4/10. So we're seeing an increase, and then the next month out, further out in November, we can see that the closing price is $9.45, and then in January of 2018 it's $9.52. So this is a typical carrying charge market. Nothing fancy about it. Doesn't mean that we can't find bull markets in an environment like this. It just means that the likelihood of a parabolic move or a rapid increase, aggressive repricing of the commodity is far less likely to occur than that of if it had a premium. Now, looking at a market that has a premium in it,
this on. Are listed on bar column. It shows last here. That's going to represent the closing price. Now, obviously, at the time of this recording, I was getting prices, and they may not be representative of closing prices, so just for disclosure's sake. But we're going to assume for a moment that we were looking at the market after they closed, and we look at the closing price, or in this case, the last. And generally, if there's a cash market that could be seen for a commodity, they'll list it first on barchart.com, and that'll be at the top of the list. And then immediately below that, you'll see the first contract delivery month, or what is referred to as the nearby contract. The immediate contract month right after the nearby is always referred to as the next month out. So we want to be looking at the nearby and the next month out always, okay, in contrast to whether there is a premium. When there is no premium, we have what is referred to as a carrying charge market. Now, carrying charge market is simply today's price viewed in the nearby contract. If today's price is $9.40 on the July contract of 2017 soybeans, we could see in August, the next month out, there should be an increase in that premium or closing price, and we see it here. So in July 2017 nearby contract, and there is no premium without. So, and then immediately below that, you'll see the first contract delivery month, or what is referred to as the nearby contract. The immediate contract month right after the nearby is always referred to as the next month out. So we want to be looking at the nearby and the next month out always, okay, in contrast to whether there is a premium. When there is no premium, we have what is referred to as a carrying charge market. Now, carrying charge market is simply today's price viewed in the nearby contract. If today's price is $9.40 on the July contract of 2017 soybeans, we could see in August, the next month out, there should be an increase in that premium or closing price, and we see it here. So in July 2017 soybeans, closing price would be representative of $9.40, and in August, its closing price would be representative of $9.43 and 4/10. So we're seeing an increase, and then the next month out, further out in November, we can see that the closing price is $9.45, and in January of 2018, it's $9.52. So this is a typical carrying charge market. Nothing fancy about it. Doesn't mean that we can't find bull markets in an environment like this. It just means that the likelihood of a parabolic move or a rapid increase, aggressive repricing of the commodity is far less likely to occur than that of if it had a premium. Now, looking at a market that has a premium in it, we're looking at feeder cattle here. Again, barchart.com, we can see the cash market listed first, and the nearby contract at the time of this presentation is August 2017's feeder cattle, and its closing price, if it were closing prices, would be $154.80, and the next month out would be September 2017 feeder cattle with its price of $154.125. So the nearby contract is selling at a higher price, not much, but it's selling at a higher price, so therefore we're at a premium. Now, the way you look for whether there's a strong premium or a really significant premium is you want to go out to the next month beyond the next month out. So in other words, you want to look at the next few months. So for August, yes, there's a premium based on the price that's seen in September, but in October, we have it cheaper even still at $152.775. And then in November, we have even lower prices at 151.275, and then it drops off in January down to the 145s. So there is a premium in the feeder cattle market. So now what does this imply? It means that there is something fundamentally strong about that particular commodity. In other words, the demand is high and the supply is short. Okay, so you've never really heard me talk about supply and demand, because I think that way of trading, especially as it relates to Forex, isn't the real thing you should be doing. But there are real supply and demand factors with commodities, because they're real tangible things and people need to eat. So like I said, if you like cheeseburgers, and steaks, you're getting it from feeder cattle. So we're seeing a clear, obvious premium, and that's seen by today's price being higher than that of the next month out and the future months in the future. So if the price today's nearby contract is higher than the contract delivery months that are after it in terms of the calendar going forward, that is a premium market. This $125. So the nearby contract is selling at a higher price, not much, but it's selling at a higher price, therefore we're at a premium. Now, the way you look for whether there's a strong premium or a really significant premium is you want to go out to the next month beyond the next month out. So in other words, you want to look at the next few months. So for August, yes, there's a premium based on the price that's seen in September, but in October, we have it cheaper even still at 152.775. And then in November, we have even lower prices at 151.275, and then it drops off in January down to the 145s. So there is a premium in the feeder cattle market. So now what does this imply? It means that there is something fundamentally strong about that particular commodity. In other words, the demand is high and the supply is short. Okay, so you've never really heard me talk about supply and demand, because I think that way of trading, especially as it relates to Forex, isn't the real thing you should be doing. But there are real supply and demand factors with commodities, because they're real tangible things and people need to eat. So like I said, if you like cheeseburgers and steaks, you're getting it from feeder cattle. So we're seeing a clear, obvious premium, and that's seen by today's price being higher than that of the next month out and the future months in the future. So if the price today's nearby contract is higher than the contract delivery months that are after it in terms of the calendar going forward, that is a premium market. This promotes the idea of what is referred to as a commercial bull market. That means that the commercials, large dominant users and of this commodity, will be looking to take delivery of it right now immediately, because they have to have it and it's a short supply of it. So if they're willing to pay a premium price for it now versus what would be expected as a carrying charge premium later on in delivery months, they know that there's something fundamentally going on, that they have to get the delivery of this commodity right now. So that's what causes these premiums to build up. Another example here is seen in live cattle. You see the cash market at the top. The delivery month for the nearby is June. Its closing price would be representative 131.20. And then the next month out is August at 124.175. And then in October, we can see 120.40. So again, there's a premium in the nearby month. Next out months are selling at a lower price. So there's a premium here, implying that there is a short supply, and the traders, or those that are commodity right now. Another example here is seen in live cattle. You see the cash market at the top. The delivery month for the nearby is June. Its closing price would be representative 131.20. And then the next month out is August at 124.175. And then in October, we can see 120.40. So again, there's a premium in the nearby month. Next out months are Okay, so let's take a look at a case study, and this is going to be done on the cotton market. And again, as I open up this teaching, this is all the delivery months for cotton. And knowing now what you're supposed to be looking for, and it's very simple, I want to ask you a simple question. Does the cotton market show us a carrying charge market, or does it show a premium market? Again, we start by referencing the nearby cotton.
Carrying
contract versus the next month out. There's a premium here. Okay, so cotton is selling at a premium. So now we have the conditions that are ripe for a commercial bull market. Now, what is a commercial bull market? A commercial bull market. Now,
am I like stuck or something?
For trading may not be representative of closing prices, so just for disclosure's sake. But we're going to assume for a moment that we were looking at the market after they close, and we look at the closing price, or in this case, the last. And generally, if there's a cash market that could be seen for a commodity, they'll list it first on barchart.com, and that'll be at the top of the list. And then immediately below that, you'll see the first contract delivery month, or what is referred to as the nearby contract. The immediate contract month right after the nearby is always referred to as the next month out. So we want to be looking at the nearby and the next month out always, okay, in contrast to whether there is a premium. When there is no premium, we have what is referred to as a carrying charge market. Now, a carrying charge market is simply today's price viewed in the nearby contract. If today's price is $9.40 on the July contract of 2017 soybeans, we could see in August, the next month out, there should be an increase in that premium or closing price, and we see it here. So in July 2017 soybeans, closing price would be representative of $9.40, and in August, its closing price would be representative of $9.43 and 4/10. So we're seeing an increase, and then the next month out, further out in November, we can see that the closing price is $9.45, and in January of 2018, it's $9.52. So this is a typical carrying charge market. Nothing fancy about it. Doesn't mean that we can't find bull markets in an environment like this. It just means that the likelihood of a parabolic move or a rapid increase, aggressive repricing of the commodity is far less likely to occur than that of if it had a premium. Now, looking at a market that has a premium in it, we're looking at feeder cattle here. Again, barchart.com, we can see the cash market listed first, and the nearby contract at the time of this presentation is August 2017's feeder cattle, and its closing price, if it were closing prices, would be $154.80. And the next month out would be September 2017 feeder cattle with its price of $154.125. So the nearby contract is selling at a higher price, not much, but it's selling at a higher price, so therefore we're at a premium. Now, the way you look for whether there's a strong premium or a really significant premium is you want to go out to the next month beyond the next month out. So in other words, you want to look at the next few months. So for August, yes, there's a premium based on the price that's seen in September, but in October we have it cheaper even still at $152.775, and then in November we have even lower prices at $151.275, and then it drops off in January down to the 145s.
Okay.
So there is a premium in the feeder cattle market. So now what does this imply? It means that there is something fundamentally strong about that particular commodity. In other words, the demand is high and the supply is short. Okay,
This
so
is
you've never really
anticipated
heard me talk
range.
about supply and demand, because I think that way of trading, especially as it relates to Forex, isn't the real thing you should be doing. But there are real supply and demand factors with commodities because they're real tangible things,
why it
and
can
people
be
need to eat.
applied.
So, like I said, if you like cheeseburgers, and steaks, you're getting it
It
from
is big.
feeder cattle. So we're seeing a clear, obvious premium, and that's seen by today's price being higher than that of the next month out and the future months in the future. So if the price today's nearby contract is higher than the contract delivery months that are after it in terms of the calendar going forward, that is a premium market. This promotes the idea of what is referred to as a commercial bull market. That means that the commercials, large dominant users of this commodity, will be looking to take delivery of it right now immediately because they have to have it and it's a short supply of it. So if they're willing to pay a premium price for it now versus what would be expected as a carrying charge premium later on in delivery months, they know that there's something fundamentally going on, that they have to get the delivery of this commodity right now. So that's what causes these premiums to build up. Another example here is seen in live cattle. You can see the cash market at the top. The delivery month for the nearby is June. Its closing price would be representative 131.20, and then the next month out is August at 124.175, and then in October we can see 120.40. So again, there's a premium in the nearby month. Next out months are selling at a lower price. So there's a premium here, implying that there is a short supply, and the traders or those that are looking or seeking delivery of the actual commodity, the actual cattle themselves, the interest is so strong that they have to be paying a premium now for it because, again, the supply is short, but the demand is exceedingly high. Okay, so let's take a look at a case study.
Let's try this shit again.
And this is going to be done on the cotton market.
Premium.
And again, as I open up this teaching, this is all the delivery months for cotton. And knowing now what you're supposed to be looking for, and it's very simple, I want to ask you a simple question. Does the cotton market show us a carrying charge market, or does it show a premium market? Again, we start by referencing the nearby contract versus the next month out. There's a premium here. Okay, so cotton is selling at a premium, so now we have the conditions that are ripe for a commercial bull market. Now, what is a commercial bull market? A bull market is classically seen with higher highs and higher lows and price increasing over time, obviously. But there's two different kinds of bull markets. One that goes up gradually, stair-stepping, higher and higher and higher, and then there's another type of bull market that goes parabolic and vertical. And it does it quickly, and the amount of speed and magnitude the move takes place is usually a signature and hallmark of a premium-based rally. So usually the commodities that have a premium built in, like we're discussing here, they have a tendency to move really quick in a lot of distance in a short amount of time. Okay, so we're looking at here, this is the daily chart of the nearby contract for cotton, represented by the July contract. And I want you to take a look at price. Obviously, when we look at commodities, nothing is different in terms of how I look at price action. Everything is based on PD arrays, premium, discount. Now, when I say premium, when it refers to commodities, it's the specific pricing of the nearby to the next month out. If the nearby contract is selling at a higher price than the next month out, that is a premium. Do not confuse that with premium and discount PD arrays. Okay, in other words, the PD array matrix. Don't get confused by that. But in this particular commodity case study, we're going to look at the implementation of the things that I've already taught you, and now using it with gauging whether there's institutional buying with a premium market. Okay, so now what we want to do is once we load up our nearby contract, we want to develop a spread chart. Okay, and a spread chart is the difference plotted between the nearby contract and the next month out. You do that by going to barchart.com and you click on the little tab in the lower right hand corner here to start the spread chart. And I'm going to do a real quick overview of it. Once you load your chart up, go over to the chart type, click to spread chart. Okay, and you want to go over to where it says first symbol. I'm going to click on that, drop down into your commodity of choice, and we're looking at cotton now. So we're going to go to the cotton market tab, click on it. Then we're going to use
Oh, I missed it. Damn. I wonder what I was doing at 420. That's for 420. I'm on stream actually. You can go on my YouTube. Hi. Hi, Julie.
Used the nearby contract delivery month, and that is July, and that's trading in the year 2017. And then we're going to go over to the second symbol. We're going to be doing a spread between the nearby to the next month out. So again, you use cotton, and the next month out is going to be October. And again, trading in 2017. And this is real important. Next thing you want to do is click on this little tab here and make sure it's to the minus symbol, because that's going to give you the difference between the nearby and the next month out. And just scroll down here a little bit, click on the draw, and now voila, we have the cotton spread chart between the July and October months. The outcome is what you see here, and the significance of this is the zero line. Okay, so anything above the zero line represents the amount of spread that the nearby contract is trading above the next month out. Ideally, the larger the spread, the stronger the likelihood of a commercial bull market or a parabolic move. I want you to take a look at that spike up we saw in May. We're going to do a little bit of analysis there. But at that high in May, at its peak, the July contract was trading at 6.50 premium higher than the October delivery contract. So in other words, for July cotton, it was 6.50 higher than the October delivery contract for cotton. Now this is an overlay, and I had to create this with the software package that I create my videos with, but I did it so that way you can see graphically what it is you're using the spread chart for. So when we look at price and we are expecting higher prices, why would we expect higher prices? Well, cotton has been going higher and went into a consolidation. From January this year, it went higher. Then from March, April, May, it was in consolidation, but it had a premium. We also saw price trade down into a bullish order block in the first half of May. But I want you to look at the successive lower lows in that May decline. We made lower lows each candle, each day, but look at the spread line. The spread line was actually increasing, or in this case, diverging bullishly. Now, it kind of looks like an indicator, doesn't it? And it is, because it's price. Remember, price will tell you everything about price. We don't need to crunch any numbers, and you don't have to do any kind of acrobatic mathematics. It's simply an overlay of the spread of the nearby to the next month out. So what we do is we want to look for bullish divergence between price action of the nearby contract and the spread. So yes, it's going to take a little bit of work on your part to be looking for these things and studying them. Do you need an overlay like this? No. But I did it so that way everyone could see it easily without any miscommunication at all. You can see clearly the spread chart and the nearby July contract for cotton being overlaid with one another. You can see the divergence of the spread. Now, what's the significance of that? That's a buy signal. Going back to our July contract of cotton, we understand that institutional order flow is going to see bullishness when we trade down into a previous down close candle that saw price move away from it. That's seen here as your typical bullish order block. It's also trading down into the April high to April low range into a discount. So the PD array matrix for that range, we're in a discount range. We're at a bullish order block in a market, cotton showing a premium, July trading at a higher price than that of the next month out, October. So we see lower lows in price action as we trade into the bullish order block. But we saw the spread diverging bullishly. That is only being shown when institutions are stepping in and buying a lot of it quickly, massively. So if you ever see that when a market has a premium and it's underlying bullishness and it's in a discount and we trade down into a discount array like a bullish order block or closes in a void, price. Obviously, when we look at commodities, and see the move for cotton. Obviously, when we raise by the premium, okay, in this with my contract, we want to you do that by going to barchart.com and you click on the little tab in the lower right hand. And I'm going to do a real quick review of spread chart. Okay, and you want to do your commodity of choice, and we're looking. Then we're going to use the nearby contract delivery month, and that is July. And that's trading in the year 2017. And then we're going to go over to the second symbol. We're going to be doing a spread between the nearby to the next month out. So again, use cotton, and the next month out is going to be October. And again, trading in 2017. And this is real important. Your chart up, you go over to the chart type, click to spread chart. Okay, and you want to go over to where it says first symbol. You want to click on that, drop down into your commodity of choice, and we're looking at cotton now. So we're going to go to the cotton market tab, click on it. Then we're going to use the nearby contract delivery month, and that is July. And that's trading in the year 2017. And then we're going to go over to the second symbol. We're going to be doing a spread between the nearby to the next month out. So again, you use cotton and the next month out is going to be October. And again, trading in 2017. And this is real important. Next thing you want to do is click on this little tab here and make sure it's to the minus symbol, because that's going to give you the difference between the nearby and the next month out. And just scroll down here a little bit. And the nearby and then make sure it's to the minus symbol. And again, trading in 2017. And this is real important. Next thing you want to do is click on this little tab here and make sure it's to the minus symbol, because that's going to give you the difference between the nearby and the next month out. And just scroll down here a little bit, click on the draw, and now, voila, we have the cotton spread chart between the July and October months. The outcome is what you see here, and the significance of this is the zero line. Okay, so anything above the zero line represents the amount of spread that the nearby contract is trading above the next month out. Ideally, the larger the spread, the stronger the likelihood of a commercial bull market or a parabolic move. I want you to take a look at that spike up we saw in May. We're going to do a little bit of analysis there. But at that high in May, at its peak, the July contract was trading at 6.50 premium higher than the October delivery contract. So in other words, for July cotton, it was 6.50 higher than the October delivery contract for cotton. Now this is an overlay, and I had to create this with the software package that I create my videos with, but I did it so that way you can see graphically what it is you're using the spread chart for. So when we look at price and we are expecting higher prices, why would we expect higher prices? Well, cotton has been going higher. It went into a consolidation. From January this year, it went higher. Then from March, April, May, it was in consolidation, but it had a premium. We also saw price trade down into a bullish order block in the first half of May. But I want you to look at the successive lower lows in that May decline. We made lower lows each candle, each day. But look at the spread line. The spread line was actually increasing, or in this case, diverging bullishly. Now, it kind of looks like an indicator, doesn't it? And it is, because it's price. Remember, price will tell you everything about price. We don't need to crunch any numbers, and you don't have to do any kind of acrobatic mathematics. It's simply an overlay of the spread of the nearby to the next month out. So what we do is we want to look for bullish divergence between price action of the nearby contract and the spread. So yes, it's going to take a little bit of work on your part to be looking for these things and studying them. Do you need an overlay like this? No. But I did it so that way everyone could see it easily without any miscommunication at all. You can see clearly the spread chart and the nearby July contract for cotton being overlaid with one another. You can see the divergence of the spread. Now, what's the significance of that? That's a buy signal. Going back to our July contract of cotton, we understand that institutional order flow is going to see bullishness when we trade down into a previous down close candle that saw price move away from it. That's seen here as your typical bullish order block. It's also trading down into the April high to April low range into a discount. So the PD array matrix for that range, we're in a discount range. We're at a bullish order block in a market, cotton showing a premium, July trading at a higher price than that of the next month out, October. So we see lower lows in price action as we trade into the bullish order block. But we saw the spread diverging bullishly. That is only being shown when institutions are stepping in and buying a lot of it quickly, massively. So if you ever see that when a market has a premium and its underlying bullishness and it's in a discount and we trade down into a discount array like a bullish order block or closes in a void or fair value gap, or if we trade below an old low, in this case we had that being seen with the last 2 trading days of April. We traded below those equal lows that's seen in April around that 77.80 level, and price trades down into the bullish order block. So we have a run on sell stops, we have a run into a bullish order block, and we have what would otherwise be, I'm sure if we put a Fibonacci on it, would be optimal trade entry long at the 79 subtraction level. I didn't do it, but just by my eye, I can see that's most likely what's happening. So we're seeing a spread divergence. This is a bullish spread divergence between a nearby next month out. And when we see these indications in price, it gives us a strong willingness to support the idea of being a buyer. So we could be a buyer at 77 and it moved all the way up to 87. That's 10-cent move. 1 cent move is $500 in cotton. That's a $5,000 move in the course of less than a week. Less than 1 week, one contract in cotton pays out over $5,000. Now, obviously, we have the benefit of hindsight here. And obviously, you all know that I have not been trading commodities for a long, long time. I've been primarily a Forex trader. But these things are there every year. Every single year, these are the hallmarks to what makes commodity trading fun, in my opinion. If we can spend time looking at the, dare I say it, fundamentals of a commodity market, we can get to a really strong bias for when we want to be a buyer. Now, this repeats itself in an opposite framework when there is a premium in the marketplace. If the market makes a higher high, say for instance if cotton trades up to say 90 cents, goes higher than the 87 high we're noting here, but it does so with a lower peak in the spread, that does not promote or significantly confirm institutional buying. You have to take that with a grain of salt, because just like anything else, the spread, you want to see that increase with the advancement in price. So if it's strong in terms of its premium, driven rally, that spread should be increasing as price rallies up. So if we see a divergence bearishly where the spread fails to make a higher high with a higher high in price, that would be an indication that we would have to look for reasons to trail our stop loss, or maybe even take some profits and wait for a new buy signal as outlined here. So now you've been armed with a wonderful smart money tool, and this works in all the commodities. And if you look at it from a fundamental standpoint, you'll always be trading with the fundamentals if you're using a premium-based idea like we're describing here. So if you ever had a doubt whether or not fundamentals are needed, in my opinion, they are for commodities because they are tangible, real things. That's the world's grocery store. Everything that you eat or consume or need to operate, this world, okay, it's usually in our commodity markets. So now you have a way of framing institutional buying and selling and know when they're going to be doing explosive moves in the marketplace. Until next lesson, I wish you good luck and good trading. Okay, folks, this is our last discussion for commodities for the month of June 2017 content. We will be revisiting commodities in the month of August with the top-down analysis templates. But as a reminder, it's very important to read the disclaimer here, and to remind you also, I'm not a commodity trade advisor. I'm not licensed to give trade advice. Everything that's being discussed here as it relates to commodities is in capacity of paper trading only. Okay, folks, June 2017 ICT Mentorship, ICT Commodity Trading Lesson 5, Open Interest and Smart Money Footprints, the real secrets to using open interest. Okay, folks, open interest in the commodity markets. All right, so when I first started as a commodity trader, everyone that's familiar with me understands that I got really baptized by Ken Roberts, much like most of the commodity traders in North America. Back in the 80s and 90s, he put out a rather basic commodity trading course. And while it was not enough to make money with, it did allow me to develop an insatiable desire about the financial markets. So by getting involved with Ken Roberts, buying his course, obviously he sold my name to a mailing list, and then Larry Williams, of all people on the trading circuit, got a hold of my address, and then, like everyone else, solicited information, and I purchased it. So Larry Williams was the first in the list of my mentors, and his open interest concepts is basically widely known, and I built on what he gave as general guidelines. So everything I'm going to teach you here is pretty much what I learned from Larry Williams, with a couple twists of my own that I picked up along the way. So before we begin, we have to outline and define what open interest is, because I know some of you are going to ask, what is open interest? And while that could be answered simply with a Google search, for completeness sake, I'm going to include it here. The open interest is the total number of outstanding contracts that are held by market participants at the end of each trading day. Now, where volume measures the pressure or intensity behind a price trend, open interest measures the flow of money into a futures market. Now, for each seller of a futures contract, there must be a buyer of that contract. Thus, a seller and a buyer combine to create only one contract. Therefore, to determine the total open interest for any given market, we need to only know the totals of one side or the other, buyers or sellers, not the sum of both. The commodity markets have a built-in advantage or additional insight shared by the way of open interest. The study of open interest can provide a trader a very important perspective in a commodity. There are two ways to view open interest as a trading tool: measuring the strength of a trend or price move, and tracking the footprints of the large commercial traders. We're going to first take a look at measuring trends and or price moves with open interest. Price moves with open interest. Using open interest in trends and swings, if prices are in an uptrend and open interest is rising, this is a bullish sign. There are shorts who are being stopped out, but new sellers are taking their place. As the market continues to rise, the longs get stronger and the shorts get weaker. If prices are in a downtrend and open interest is rising, this is a bear sign. Weak longs are being stopped out, but new buyers are taking their place. As the market continues to fall, the shorts get stronger and the longs get weaker. Put another way, as long as the open interest is increasing in a major trend, it will have the necessary sponsorship to continue. If prices are in an uptrend and open interest is falling, this is a bear sign. The old longs, the smart money in this case, are banking gains as they're liquidating. They are replaced by new buyers who do not have the strength on balance, but the declining open interest is an indication that the weak shorts are also exiting. They will be replaced by new shorts who are stronger than the old shorts that were trading earlier, but got squeezed out. If prices are in a downtrend and open interest is falling, this is a bullish sign. Smart money, the shorts, are covering and liquidating profitable shorts. They will be replaced by new shorts not as strong as they were, but the declining open interest indicates the squeezed longs are bailing. They will be replaced by new longs who are not as weakened by the lower prices as the old longs were. Put another way, when the supply of losers is exhausted, the downtrend ends. All right, using open interest in consolidations. supply of losers is exhausted, the downtrend ends. All right, using open interest in consolidations. If prices are in a consolidation and open interest is rising, this is a bear sign. The reason is the street money plays the long side. Rising open interest in a trading range suggests commercial hedgers and professionals are taking the short side, and the uninformed speculators will fall victim to the downside break in price. Now think about what causes open interest. It's the commercial hedgers are the largest liquidity provider, and they offer the commodity for purchase for trading.
Forgot I had muted myself.
If they're willing to sell a lot of it, that means that they don't believe that prices are going to go higher. Otherwise, they would hold out and wait for higher prices. So, since they're the most largest pool of counterparty to commodity traders, if the open interest is rising, they have an expectation that prices are not going to increase because on balance, they're larger as a supplier or seller of a commodity than they are a buyer. So open interest increasing provides a measure of their willingness to be a heavy seller. So if open interest is high, that means they have a very high interest, again, on seeing lower prices. We can see that graphically here with the cumulative line that's being drawn crudely by myself. When that increases while the market stays in a range, price will break down generally, and the commercials will be the indication of that. Now, when we see this, we want to couple this with COT hedging programs or the net trader position as a whole. We can look at what the commercials are doing. In this case, we want to see the commercials net short or increasing their short selling. Now, if prices are in a consolidation and open interest is falling, this is a bullish sign. The reason is the commercials hedgers who are most likely shorting are covering. The street money will be shorting and expecting a breakout lower in price. This is seen graphically with the cumulative line at the bottom here. That would be open interest declining while price stays in a range at a key support level, and the market breaks to the upside. Ideally, we want to look for long-term or higher time frames for the levels in price to anticipate this open interest concept. In times where price is trading at key support levels on a higher time frame basis, open interest will decline or drop while price is consolidating at or near a higher time frame support, or as we define it, a discount array, as we outline institutional reference points. This will be bullish and anticipate an upswing in price. Conversely, we want to look for long-term or higher time frame resistance levels in price to anticipate this open interest concept. In times where price is trading at a key resistance level on a higher time frame basis, open interest will rise while price is consolidating at or near the higher time frame resistance or a premium array as we outline institutional reference points. This will be bearish, and we anticipate a downswing in price. Now, when we look at open interest, there's rejecting a key support level, and the market breaks to the upside. Ideally, we want to look for long-term or higher time frames for the levels in price to anticipate this open interest concept. Higher support level. Hedge validation and open interest is falling. This is a bullish sign. And with the commercials, while the price a measure of their willingness to be a heavy seller. So if open interest is I'm seeing with commercials will be the indication for the net trader's position as a whole. We can look at what the commercials are doing. In this case, we want to see shorting or covering. The street money will be shorting and expecting a breakout lower in price. This is seen graphically with the cumulative line at the bottom here. That would be open interest declining while price stays in a range at a key support level. And the market breaks to the upside. Trading at key support levels on a higher time frame basis, open interest will decline or drop while price is consolidating at or near a higher time frame support, or as we define it, a discount array, as we outline institutional reference points. This will be bullish and anticipate an upswing in price. Conversely, we want to look for long-term or higher time frame resistance levels in price to anticipate this open interest concept. In times where price is trading at a key resistance level on a higher time frame basis, open interest will rise while price is consolidating at or near the higher time frame resistance or a premium array as we outline institutional reference points. This will be bearish and we anticipate a downswing in price. Be bearish and we anticipate a downswing in price. Now when we look at open interest, there's obviously the way we can see this is we can see it on barchart.com, and let me just say this, barchart.com, if you do the total open interest and volume, that will give you the true open interest reflection for declines and rallies in its cumulative basis line, and compare that with price action. But to get a better picture, you're going to have to avail yourself a resource or two. And I like CRB Trader and I like pricecharts.com. And the reason why, if you're going to be a commodity trader, and yes, I still subscribe to these mediums, even though I don't actively trade the commodities market, I use it for my Forex analysis. So when I'm looking for quarterly shifts, or if I'm looking for mega trades, as we're going to teach next month, the idea is I look at the seasonal average of open interest, and both pricecharts.com and CRB Trader both plot this for you. What it is you can see the dotted cumulative line here, and all the arrows here, you can see where it's pointing to it. That is the average of a multi-year, or as I'd like to look at it, as a seasonal average over the last few years of what open interest usually has done. And as you can see, around the June, September, and December time periods, which are generally the contract expiration and rollover period. And when I teach open interest, invariably someone's going to say, well, what you're seeing there is the contract rollover and expiration. And while that's generally built into it, yes, it's not indicative of the entire answer. Okay, so there are going to be times when open interest reflects a great deal of buying and a great deal of shorting by the commercials. So if we are seeing contract expiration and traders are trading, for instance, say this is copper, okay, if copper prices are seeing a bull market, just because the contract expiration is what we're seeing here suggested. I'm not saying these are the delivery month expirations, but this is say that, for instance, it is, or it's the S&P 500, for instance. Okay, these months, because they're expiring as they normally would upon delivery, when that last trading day takes place, if traders are still bullish or bearish, they're just not going to stop trading because that contract expires. They're going to sell or buy to cover their position in the nearby contract and roll right over into the next month out. So open interest will still be reflected. It won't change anything, okay, because we'll be replacing one for one. So by looking at open interest like this, what I like to see is if open interest declines, or in this case, many times it can rally above, if it goes above the seasonal tendency or the average of what that dotted line is, for instance, from the period of June all the way through to the second week of September, open interest, which is the solid dark line, what I do is I look at the difference between open interest actual number and the seasonal average by getting a better feel or intensity about what the commercials are doing as a whole. By taking the black line and comparing it to where the dotted line is. The dotted line again is the average over several years, and the actual is the solid black line. Okay, so the solid black line is above, between June and September, the normal multi-year average. So that's actually, if it were in a bearish environment, we were trading at a resistance level, I could be expecting some really nice increases in open interest at a resistance level while it's above the average of its open interest normal, seasonal. That would be bearish. But when it drops down below the average, or that dotted line of open interest, that's a multi-year average of open interest. So when the black line drops below that dotted line, what that's indicating here is the commercials are really covering shorts. They're well below in September than their average of open interest movement. So in this case, if the commodity that we're trading was at a bullish environment, in other words, at a long-term support level at discount array, and we've seen this condition and price was in a consolidation, that would be extremely bullish, and I would expect that price to go higher. Okay, so let's take a look at a case study here. We're looking at the British pound, and I have a monthly chart here, and we're looking back in the 2010 time period. And I want you to see that we have a bullish order block outlined from 2009's trading, and then we have a bullish order block from early part of 2010. So we have the bullish order block noted here, and we have another bullish order block here. We're going to look at the second condition here because we have institutional order flow suggesting higher prices because price had respected a mid-2010 bullish order block response off of a 2009 bullish order block, and then price rallied through the higher order block, the second one's being denoted here, and price trades down to it and finds some support there. So we're going to go into that price level and get a better look. And we're going to go into a weekly chart, and we can see at that same period in September 2010, the commercials were net long, and we're going to be looking specifically at that little nodule in price, or that low. You can also see it's trading back down into an old bullish breaker seen in the first quarter of 2010. Okay, we're going to take ourselves over to an old chart on CRB Trader,
and I'm going to highlight that 153 level. That's the higher time frame support level or bullish order block. And we zoned in right in here during our period of consolidation and price. Open interest takes a dive, and look what it does. It goes down below the dotted line, or the average or seasonal tendency for open interest. That is extremely bullish. Price, as a result, rallies with the open interest dropping at a support level, while price is in consolidation with the net trader position showing the commercials are bullish. That's a wonderful condition to be in, expecting higher prices. Footprints of the smart money is clearly being shown here. They can't hide what they're doing, covering shorts, and price moves in the British pound over 800 points. So in a short span of time, less than 2 months, price sees a rally of 800 points, or in the Forex market, that would be 800 pips. Okay, we're going to look at another example here. Euro, we're looking at the weekly chart here. The commercials are bullish. See them above the zero line right here, and look at the extreme bullish reading we had prior to it, just left of that, when the price made its low in the early part of 2010. Then we have price rallying off of that low and then having a retracement off of 133 down into a support level of 126. 126 is a bullish order block, the last two down weekly candles. You see that is finding also at the same time the bullish net traders position. Okay, we see those last two down closed candles here. I'm highlighting the high of that series of two down weekly candles as our bullish order block, and price trading back down to that bullish order block as a discount array, again with commercials net long. So we're going to go into a daily chart back in 2010. You see how I have the range outlined, a small little consolidation there, and we see the 126 higher time frame support level. Now, at the same time, we see open interest take a dive, and again, what happens? It drops down below the seasonal average of open interest. Again, we don't just simply look at that black solid line. That's not enough. If open interest is going to decline, as you can sometimes see with the average or the dotted black line, it does drop down in September, but look how much it drops down in actual open interest. That's totally different. That's a different storyline altogether. Price moves in an amazing 1,500 pips or points for this specific commodity. Open interest drops at a support level while price is in consolidation. Net trader position is bullish. Amazing price response there, and look how fast price moves up. Does not spend a lot of time dilly-dallying around. It completely vaults from the 126, 127 level all the way up into the 142s. So again, in less than 2 months, 1,500 points, or in the Forex market, that would be over 1,500 pips available as a price swing. So now, when we talk about these things, obviously, we're not just giving, examples of where it works once in a while, because it works on a higher time frame basis. So these open interest ideas are not day trades. They're really selected for swing trading, position trading, or to get your trading in sync with that larger move. Say, for instance, we looked at this scenario and it was the first week of October. We can see that that price move has a lot more significance behind it because it's a large macro play. So there's going to be a dominant support structure behind it for higher prices. So we can go back and look into that weekly chart and see where price may reach for a premium array. And while that still has not been fulfilled, we can be looking for day trades where the open is near the low of the day and then rally up, or look for one shot, one kill for expansions on the weekly range for a higher Friday close from the week's opening. So the way I use open interest, again, is not just simply is open interest declining or is it rallying. I have to have it coupled with a higher time frame level, because understanding what the hedgers are doing, the commercials, they have a more closely tied relationship to what price is actually doing based on what it should be doing fundamentally. And they also look at the higher time frame charts to value price levels historically for valuation, and the idea of looking for, so the chart back is because again is the monthly chart here, and we're looking back at the block. Look at the suspected response off of
order block there. So September 2010. In the first, take ourselves over to an old chart on CRB Trader. And I'm going to highlight that 153 level. That's the higher time frame support level or bullish order block. And we zoomed in right in here during our period of consolidation and price. Open interest takes a dive, and look what it does. It goes down below the dotted line, or the average or seasonal tendency for open interest. That is extremely bullish. Price, as a result, rallies with the open interest dropping at a support level while price is in consolidation, with the net trader position showing the commercials are bullish. That's a wonderful condition to be in, expecting higher prices. Footprints of the smart money is clearly being shown here. They can't hide what they're doing, covering shorts, and price moves in the British pound over 800 points. So in a short span of time, in less than 2 months, price sees a rally of 800 points, or in the Forex market, that would be 800 pips. Okay, we're going to look at another example here. Euro, we're looking at the weekly chart here. The commercials are bullish. See them above the zero line right here. And look at the extreme bullish reading we had prior to it, just left of that, when the price made its low in the early part of 2010. Then we have price rallying off of that low and then having a retracement off of 133 down into a support level of 126. 126 is a bullish order block, the last two down weekly candles. You see that is finding also at the same time the bullish net trader's position. Okay, we see those last two down closed candles here. I'm highlighting the high of that series of two down weekly candles as our bullish order block, and price trading back down to that bullish order block as a discount array, again with commercials net long. We don't just simply look at that time frame support level. Now, at the same time, we see open interest take a dive, and again, what happens? It drops down below the seasonal average of open interest. Again, we don't just simply look at that black solid line. That's not enough. If open interest is going to decline, as you can sometimes see with the average or the dotted black line, it does drop down in September, but look how much it drops down in actual open interest. That's totally different. That's a different storyline. All macro line into a daily 133 down into a support level of 126. You see that? See those last two candles are back in 2010. You see how I have the range outlined? Now see open interest average. If open, that's totally moves up. We looked at this scenario, the net traders, while at resistance levels or premium arrays, we can anticipate. Okay, folks, welcome back. This is our first lesson in ICT bond trading concepts. Again, we're dealing with commodities, so it's very important that I remind you that I'm not a licensed CTA. This is not trade advice, and everything that's being referred to in this month's content and in these lessons are referred to as a paper trade only. Okay, June 2017 ICT mentorship, ICT bond trading, lesson 1, basics and opening range concept. Okay, when I refer to the Treasury bond, what I'm referring to specifically is the 30-year Treasury bond futures contract. And the trade symbol for this is ZB,
and it's for the 30-year Treasury bond. And the trading session that these concepts I'm going to be teaching this week are primarily used for in analysis on the New York session. And it begins at 8:20 a.m. to 3 p.m. New York time. And the contract delivery months for the Treasury bond 30-year note is March, with the delivery contract code of H, June, with the contract code month of M, September, delivery contract month code U, December, delivery code contract month Z, and the format when we use for entering our charts or pulling them up in data, it's the symbol ZB, then the month code, then the last 2 digits of the trading year. For an example, ZBU17 for September 2017's contract of the 30-year Treasury bond. You can see that to the right in this image, Treasury bond September contract, ZBU17 at the top. It trades on the Chicago Board of Trade Exchange, and it is a futures contract. And you can see the only delivery contract missing here would be the March 2018. The amount per tick, minimum fluctuation is $31.25 per contract. Bond opening contract, and you can see the only delivery contract missing here would be the March 2018. The amount per tick, minimum fluctuation is $31.25 per contract. A full handle or full figure move equals 32 ticks, or is referred to as 30 seconds. 32 ticks movement equals $1,000 per contract. contract. Okay, bond opening range concept. Talking about nostalgic things here, folks. These are the things that I cut my teeth on as a commodity trader years and years ago. All right, so when we look at the bond market opening range concept, the highest volume is going to be seen between 8 a.m. and 9:30 a.m. New York time. True day for the bond market is 8 a.m. to 3 p.m. New York time. The opening range begins at 8 a.m. New York time and ends 9 a.m. New York time. Narrow your focus. The opening range between 8 a.m. and 9 a.m. tends to create the bond market high or low of the day. Range between 8 a.m. and 9 a.m. tends to create the bond market high or low of the day. It can be a run on stops or a fair value setup. In other words, a bullish order block or a bearish order block, or trade down into a liquidity void or fill in a fair value gap. It is also the location for liquidity pools to build around for the stock market opening to be rated. Let's take a look at a couple examples here. We have the Treasury bond for the September delivery contract 2017, and this is a 15-minute candlestick chart, and I have the 8 a.m. to 9 a.m. delineated here. So in this area, what we look for is the opening range, or the high and the low between those two delineations in time. As you can see here, we have a block of price action. This is our opening range. We have our opening range low, and our opening range high. And price trades down below the low that was formed between 8 a.m. and 9 a.m. This is a stop run and a potential reversal. Notice the highest volume of the day is between 8 a.m. and 9 a.m. Range high. And price trades down below the low that was formed between 8 a.m. and 9 a.m. This is a stop run and a potential reversal. Notice the highest volume of the day is between 8 a.m. and 9 a.m. Notice also on the lower low that was created post 9 a.m. New York time, that lower low was seen with lower volume. So there was massive buying taking place right after 8 a.m. But as price made that lower low, it did not see a large influx of volume. All we're seeing there is a movement towards running initial sell stops for those individuals that were correct and by buying early, just having their stop loss too close to the marketplace. This is a volume divergence, price making a lower low. That lower low should have been met with a higher bar on volume. This is a sign of impending weakness for the down move, so that means there's no more selling pressure. It's basically a run on stops. Price moves higher, finds some support, at the opening range as well. Influx of volume. Massive buying taking place right after 8 a.m. But as price made that lower low, it did not see a large influx of volume. All we're seeing there is a movement towards running initial sell stops for those individuals that were correct and by buying early, just having their stop loss too close to the marketplace. This is a volume divergence, price making a lower low. That lower low should have been met with a higher bar on volume. This is a sign of impending. This is a volume divergence, price making a lower low. That lower low should have been met with a higher bar on volume. This is a sign of impending weakness for the down move, so that means there's no more selling pressure. It's basically a run on stops. Price moves higher, finds some support at the opening range as well. Opening range high. There's price moves higher, finds some support at the opening range as well, opening range high, and finds another opportunity to see price trading high, opening range high, and finds another opportunity to see price trading higher into the latter portion. support at the opening range as well, opening range high, and finds another opportunity to see price trading higher into the latter portions of the day. Okay, another example. We have our 8 to 9 a.m. block of price action delineated. This is our opening range. Again, our opening range is defined, high and low. Opening range low. We have a order block, last two down closed candles inside of the opening range and the opening range high. As you see, price trades down into the bullish order block, supported around the notion of the 8 a.m. to 9 a.m. opening range concept, and price rallies away, basis of a bullish order block. And notice as the price makes the higher high going into the 11 o'clock hour, volume was declining as price made a new high at 154.21. Price makes a subsequent decline back down into the opening range and then goes into consolidation. The volume needed. This is our opening range. Again, our opening range is defined, high and low. Opening range low. We have a order block, last two down closed candles inside of the opening range and the opening range high. As you see, price trades down into the bullish order block, supported around the notion of the 8 a.m. to 9 a.m. opening range concept, and price rallies away, basis of a bullish order block. And notice as the price makes the higher high going into the 11 o'clock hour, volume order block. And notice as the price makes the higher high going into the 11 o'clock hour, volume was declining as price made a new high at 154.21. Price makes a subsequent decline back down into the opening range and then goes into consolidation. The volume divergence here was a early sign that the rally up into the bullish order block. And notice as the price makes the higher high going into the 11 o'clock hour, volume was declining as price made a new high at 154.21. Price makes a subsequent decline back down into the opening range and then goes into consolidation. The volume divergence here was a early sign that the rally up into the 154.21 was a weak move. Therefore, volume precedes price. Weakness was seen after 154.21 had posted. Ideally, volume should have had a higher bar on its highest high, moving into 154.21. So now we're working with commodities. We have a more accurate depiction of buying and selling pressure with real volume. The vertical lines down here, the green, blue, and dark blue lines, are delineations of volume. Weak move. Therefore, volume precedes price. Weakness was seen after 154.21 had posted. Ideally, volume should have had a higher bar on its highest high, moving into 154.21. So now we're working with commodities. We have a more accurate depiction of buying and selling pressure with real volume. The vertical lines down here, the green, blue, and dark blue lines, are delineations of volume. Okay, another example. We have our 8 to 9 a.m. delineation, our opening range low. Inside the opening range, the last down close candle is a bullish order block. There's two reference points at that order block. We have the initial test here, and we have the secondary one. Either one would fit the bill. This is a bullish order block. We expect a rally. And notice the largest volume was seen again at between 8 a.m. and 9 a.m. New York time. And price moves up to run into the 154.26 level. But notice at 154.26, look at the high that was formed right before 2 p.m. That high, that volume spike there, was not seen with a greater volume measuring later on in the day, in the evening time. So when we traded the 154.26, it was done so on light volume, but it also reached above with a divergence in volume it reached above the opening range high. So it ran the stops above that range and failed to go any higher, and then traded down and closed in the fair value gap seen at the 154.10 level. So we have a blending of things that we've already learned about in the Forex portion of this mentorship, but now we're blending other things with specific commodities. Now, when we look at the opening range for bonds, what I like to do is I like to define the opening range with, much like I did the Asian range, I look for the bodies, but also incorporate wicks. And then I also incorporate previous highs and lows that are just to the left of 8 to 9 a.m. New York time. Notice that we have the highs formed between 2 a.m. and 12 a.m. to the left of the chart. We have equal highs there just below 154.19. With that high, I'm going to incorporate the wick in between 8 and 9 a.m. That's why that's being defined there. Notice also that reference point becomes an issue for stop rating later on in the evening during the Asian session time period. When we look for opportunities, we're blending kind of like the Asian range perspective in Forex. We're looking for that same general theme occur with the 8 to 9 a.m. time period in the bond market. Now, I like to see signals form at 8:20 or after. They can occur as early as 8 a.m. and sometimes a little bit before, just like a New York session open at 7 a.m. But I generally prefer to see it occur between 8 a.m. and 8:30. So basically the target time is 8:20 or CME opening. See, there's a blending of that time element again. So if we know that there's a strong influx of New York traders coming in at 8:20 New York time, London traders are still awake. They're still on the clock looking to take some trading. And if UK traders or European traders want to be participating in the treasury markets, and it's a very big market. It's not as big as Forex, but it's very liquid. And one of the wonderful things about the bond market, it's the least manipulated of all markets. Now think about that. Remember, I made my career, focus in the commodity markets with the bonds. I like the bond market because it had the least in terms of manipulation. You don't get a lot of tomfoolery in that market compared to others. Now, it does not mean that there is a lack of manipulation. It just means on par with all other asset classes, generally you see the least with the bond market. Now, when we go into FOMC or interest rate based reports or approaching those types of things, the bond market can get a little wonky. It can get a little silly. It can do things that doesn't make any sense. And the easiest way to avoid that is simply stay out of that particular asset class ahead of news events. Once the news event drops, FOMC numbers are released, or the announcement or rate decision, anything like that, even non-farm payroll as well, there's nothing sparing the bond market when it comes to NFP. Those environments are still much like I've mentioned in other teachings regarding the Forex. You don't want to be trading around those environments because it's illiquid. The market's going to gap to wherever the liquidity is, and chances are it's going to be against your position. So it's just better not to be trading at all around those times. So if we know out of the commodity markets as a whole, if you want to carve out a career as a one focused market trader, there is a plethora of opportunities for trading the bond market. It's highly liquid. It's really nice when it's trending. When it starts to move in one direction, it generally stays in that direction. When it goes into consolidation, it can be a little choppy, but if you know what you're looking in terms of fair value gaps or turtle soups, using equilibrium ideas, there's certainly no reason why you can't carve out a small little amount of pips or ticks in this case for this particular asset. Now, obviously everyone wants to be a trader for the bond market. They want to capture 32 ticks or a full handle. and try to capture $1,000 per contract. This market generally doesn't have a large daily range. So if you can capture anywhere between 5 to 8 ticks as a intraday day trade, there's certainly nothing wrong with that. If you can get 16 30 seconds, that's $500 per contract. That's a good day. A large range day is when you get a full handle or 32 ticks or $1,000 per contract. They don't happen all the time, but there can be sustained moves that create that opportunity, but that's not the normal. So it's an asset class that allows for low expectations in terms of the daily range. It has respect of liquidity pools, liquidity gaps, fair value gaps, all the things that we taught with Forex, they still occur in this asset class, but you don't see a whole lot of the things like you do in the Forex market, where it can spike down, do some really crazy stuff, and then go right back in the direction you were trading in. Will it run your stop sometimes? Yes. Will you sometimes see something in the chart and it doesn't materialize and goes the other way? Yes. Will you see order blocks that don't go up, just go sideways? Yes. And the reverse said for bearish order blocks. Nothing about this asset class makes it perfect. But if Forex was ever to go into a meltdown, or I was unable to trade Forex, I would go back to trading bonds without skipping a beat. It would be no problem at all for me to go back to trading bonds, because it's a very good trading market. It can be swing traded, it can be short-term traded, it certainly can be day traded, and when the conditions are right, you can be in positions and hold them for longer term, dare I say it, several months. I've never been able to do that personally, but it can be done because it's like the currency, sometimes it trends very, very well. So now you have a beginning basis point to start looking at the bond market, and you can pull up barchart.com and look at a 15-minute time frame for one day. Pull up the ZBU 17, and as we go forward in time, just go to the next month out, and if we go into 2018, you're just going to change the 17 to 18 or whatever the year is respectively, and you can keep a running journal of what the bond market's doing. Now, I'm going to counsel you to do this just as a general daily procedure, even if your intentions are never to day trade or trade the bond market. Say you never want to do it right now. I promise you, by looking at it on a day-by-day basis, it will increase your price action skills. It will develop a greater appreciation for this particular asset, for commodities, for interest rates, and you're also going to start studying this in relationship to what the dollar's doing, what gold's doing, and the foreign currencies as a whole. So hopefully this has been a good introduction to the bond market and one of the most basic concepts I use when doing analysis on it. In next lesson, we're going to talk about split session rules. Okay, folks, welcome back. This is another discussion on commodities. So everything we refer to in this lesson and in this month, 2017 June content, is referring to specifically as a paper trade only. Okay, folks, June 2017, ICT Mentorship, ICT Bond Trading, Lesson Number 2, Split Session Rules. Okay, T-Bond Split Session Rules. Now, before we get into this, I understand that most of you are in this mentorship to learn how to trade with my concepts, Forex. And there's a lot of time of day references for Forex, and commodities have a unique time of day element as well. I'm going to teach you the way I interpret price action for my analysis for the bond market. There's some similarities, but there's some slight deviations. As I mentioned at the beginning of this mentorship, when we get into the commodity content, there are time of day studies, but there's a small variance what you normally expect to see in, for instance, the foreign exchange market. There's a small little overlap but then there's a small deviation from what we would normally expect for time of day. Traditionally, overnight sessions will have an impact, and that's traditionally seen as the London session.
Huh. Really, he's forcing me to become, well, not even forcing me, he's giving me the blueprints for me to know what the fuck I'm talking about. Not just how to be profitable. Well, damn. I need to just watch. There's no deciphering. Got a lot of information, I guess. Let me see what I got. A lot of information noted, but not a lot of information retained and executed yet. Because I must go through the whole more mentorship and then touch up on some things I'm doing. Which I have a mental map of things I need to touch up on, or like that I know I need to do before I can continue to the next concept. So let me see.
So, and as a result, the wheat market rallied $6,500 per contract, and the soybean market rallied $4,800 per contract. Then we are in a deflationary condition. I want to compare them with time-wise to get to this outcome. Consolidation, and we broke out of consolidation. So above equal highs, this is always going to be potentially what? A stop run. Even
after that, I go back to
trade the US 500.
Back to where I left off.
Market through like an MT4 account. And again, I'm just going to touch on that. I'm not suggesting that you should, especially those individuals in the States, because it's actually illegal for you to trade that.
Because it might be a little obstructive. I'm being facetious. You see these guys out there with these charts that have graffiti all over it. You can't even see the price candle. Nothing. You can't even see any of it. But there's all kinds of overlays of all kinds of non-sell stops offering the price in the marketplace. That's what's beginning to spool and go higher. It's skill set of identifying the detail. The more you a live account, and I have my trigger on the buy button. Okay, I'm just going to go with a buy at market. I'm not trying to. That could be a target. It's to me below and from your entry down to your target. To trade lower.
That's all that is. It's just
alright, folks. Well,
market analysis
for you. on this. But
2022.
Welcome, alright, folks. Happy New Year. Alright, folks, just a quick little video. Takes out a swing low. Welcome, alright, folks. Happy New Year. It is January 1st, 2023. Okay, it's going to go up, it's going to go down based. Start a baseline to determine what type of trading you're doing. It's real important that I don't push you into a role. Caleb needs to tell me what he wants to do. And then once he finds out what that is, he teaches me how to determine what that is for yourself. Because you don't have that direction, you don't have that pathway. You're going to see that and start suspecting that right now has relevance to right now. Well, how can we trust it? How do we know?
Oh shit. Some good shit in store for me. Alright,
New York AM session is defined by 8 a.m. New York time to noon New York time. The New York PM session is defined by noon New York time to 3 p.m. New York time. Now, before I go any further, just understand that while we are generally familiar with the New York session or New York open kill zone, and there's a London close kill zone, and then the daily range we understand can trade all the way as late as 2 p.m. There's a little bit of an overlap, but we're going to actually define it in 2 sessions. So what I'm teaching here, the analysis concept should be focused primarily on the New York session hours. While if you're going to graduate into, maybe you go through the lessons this week and you fall in love with bond trading, and you say, the heck with Forex, the heck with, stock trading and the other asset classes, I'm going to be a bond trader. Well, great. That's wonderful. If that's what you become and you find your niche in the marketplace, then great. That means that you've been a success going through the mentorship. But you can trade overnight or during the London session the ZB or 30-year Treasury bond and trade with similar things that we talked about in regards to the London Open. I would counsel you to use the information that is seen by overnight trading during the London session to look for stops, liquidity voids, fair value gaps, those types of things, and focus primarily on trading the New York session. As we mentioned in the previous Lesson 1 bond concepts, the largest volume is seen between 8 o'clock and 9 o'clock in the morning, or generally before the equities open. So between 8 a.m. and 9:30 a.m. New York time, that's the largest influx of purchasing and selling of the Treasury bond futures. The AM session has a built-in advantage because it generally will see the largest volume of the day. That means it's generally going to form the higher low of the New York session, or the blending of, or total range of, the true day for Treasury bonds. The PM session generally will have a continuation or reversal, and then the other thing is a consolidation. So generally you're going to see a move more often than not in the AM session. I tried to focus, when I was doing commodities only as an asset class, focusing primarily on 8:20 in the morning to 11 o'clock in the morning. That was like my kill zone, if you want to call it that, when I was trading the E-mini S&P, the S&P futures, big boy, and the currencies and the bond market. That was my work day. And when I wanted to be a deviant or really push my luck, I would trade the PM session. And the PM session for the Treasury bond market, it's seen here as noon to 3 p.m. Trading days can see the complete trading day be one-sided in both the AM and PM sessions. So in other words, the opening around 8 a.m. to 8:20 a.m. New York time creates the low of the day, and it can trade all the way up to 3 p.m. one-sided, completely bullish through AM and PM trend. Those sessions together create the full daily range. Trending days can start also with one of the sessions being, for instance, the PM session. For instance, there could be a late afternoon FOMC like we have tomorrow. The bond market could be consolidated during the AM session and then go into a trending environment in the PM session that carries over in what we call a runner, where you can have the move continuously go on into the next trading session or the session after that. Consolidation days can see opposing directions in the AM and PM sessions, or it can see one session produce a swing and the other be quiet or consolidate. So when we look at 2 o'clock in the morning to 5 a.m., we understand that is the traditional London session. Okay, so if we're looking at price in terms of the bond market, we can refer to what overnight price trading has seen between 2 o'clock in the morning and 5 a.m. That'll give us where our stops are, overnight stops, overnight liquidity voids, fair value gaps, any measure of PD array that we would normally use in the foreign exchange market. We would look for that to be found in this specific reference point in time. While we're not actively trading the London session, and I don't really want to trade or imply that you should be trading the London session with the bond, we refer to it always between these two reference points, 2 o'clock in the morning and 5 a.m. The AM session, or morning trend, is defined by 8 a.m. to noon. Now, sometimes the
I need more information. All right. I want to keep going, but I'm getting an impulse to stop and get some things done. So I'm gonna do that, and then if I have time, I will continue.